Good afternoon, guys. How are you guys doing? 1, 2, 3, 4, 5, 6 people we have offline, and we have 3 people connected online. Hello, Helen, Hiral. We also have Soundarya, and who's the other person? And Prashant. Okay. So we'll we'll continue from where we left. So I'll be looking at you sometimes, I'll be looking at the camera sometimes, so it will be a little awkward for some time, then I'll get used to you. This is your first offline class, right? Today's your first offline. Yesterday you had a class, okay. Yeah. So how many people came yesterday? 8 people, similar number. Okay. All right. So did someone assign seats? This is where the male gender has to sit. This is where the female. Anything like that? No, nothing like that, right? Because the other day I was taking a class and there also the same thing happened, and every year it happens like that. I wonder why that happens. So I just don't know if there is any rules with respect to that. I don't know how many people are online who are going to come. Maybe they're just testing waters to see how many people are coming and how many are not. Anyway, so it still continues like last time. So I'll be addressing people here. I'll be addressing the people online as well. So if you have any questions at any time, you can send across messages. I have connected on my mobile as well, so you can raise questions and I'll answer them. You guys can also just raise your hand and ask me questions whenever you feel like. Okay. All right. So we had started discussing inflation. So that was the last topic, 5th chapter. So inflation is the heading. We have completed the initial introduction to inflation. We have looked at the various rates of inflation. Based on the rates of inflation, how inflation is classified into various headings. We have looked at that. Then we looked at the causes of inflation, demand causing inflation, then supply causing inflation, and the different terms associated with those, and what causes an increase in demand and what causes a decrease in supply also we have seen. And we finally completed with those structural bottlenecks, the various 4 bottlenecks and the spirals. So we have completed that. The next that we have is measuring inflation. Even there I have given you a formula of how to measure inflation. But if you remember how I defined inflation, I had defined inflation as persistent rise in general price levels. Persistent rise in general price levels in an economy over a period of time. So that is how we had defined. So we discussed why we call it as persistent. We also discussed why we call it as by the term general price levels. Okay. Now there are a few reasons why we use the word general price levels. One of them I said is that it is not for one product that we are measuring inflation. We are measuring inflation for wide variety of commodities which are consumed in the economy. So it is not only about what happens to the price of one commodity, it's about a wide variety. So we create something called as a basket of goods and services before we measure whether there is inflation at the economy level. Basket of goods and services. Okay. So in this basket we have various commodities, for example, food, clothing, housing, maybe entertainment, education. So education would be there, health would be there, a lot of things would be there. I'm just restricting into just these 4. Okay. So similarly, there might be a basket with about say 5 or 6 categories and about 400 or 500 different commodities which people consume. So I've just written food. Food is not, you cannot just say this is food. Different people have different requirements with respect to food. What food means, within food there is say solid food, liquid food, all those categorizations are there. Whatever people spend on. So that is a basket of goods and services, right? And whenever we measure whether there is overall inflation in the economy, we say we don't care about individually what is happening. If the prices of, let's say there are 100 commodities over here and the prices of, let's say 70 commodities are increasing, Okay, and only 30 commodities the prices are decreasing. On the other 30 commodities the prices are decreasing. If overall the prices have not changed, the overall expenditure has not changed, then we cannot claim that there is inflation. Overall in the economy level we cannot claim there is inflation, even though in 70 of the 100 goods there is a price rise. It has been countered by the other 30 goods. So which is why overall when we spend money in a year or whatever duration of time, are we spending more money or are we spending less money? That is what we are trying to find out here. Okay, so we ask questions as to how much was spent during the previous year, how much was spent during the current year, and so on. Okay, I'm taking 2020 here because 2021 we don't have any data available. This is how we measure. Okay, here comes another problem. The other problem is that the price rise in food, the prices in food, to what extent is there a price rise, and to what extent is there a price rise in something else? It depends on a lot of factors. Now consider this example. Let's say in a year we tend to spend rupees 10,000 on food. Let's say, just taking some food. Let's say on clothing we spend only rupees 1,000 in a year, or let's say rupees 100, just to demonstrate some numbers I'm saying. So 10,000 rupees on food and 100 rupees on clothing is what we spend in a duration of time, let's say. Okay. In clothing, the price of clothing in a particular year rises by rupees 10. So the new price is 110. The price of food also rises by rupees 10, only 10. Okay. So it is 10,000, 10. In both the cases, the price rises by 10 rupees. Here also 10 rupees, here also 10 rupees. Does it represent the same level of inflation? That is a question. So we cannot say with certainty that it is the same level of inflation. We know, actually, if you look at it, we know that the impact is different. See, if the price of something is 10 rupees, I buy something for 10 rupees, the price becomes 20 rupees, the price is actually doubled. Just one second. Okay, so imagine the price of a 10 rupee commodity increases by 10, there is a 100% increase, the price has doubled. Whereas the price of a, let's say, 10,000 rupee commodity increased by 10, it's not the same change. The impact of that price rise is also not the same. Here we might probably even neglect this change. 10 rupees is nothing in the context of 10,000 rupees. But in the context of 100 rupees or in the context of 10 rupees, a 10 rupee rise is significant. To understand that, what we do is, instead of representing the price of food as the price itself, we will represent it in the form of an index. Okay, we will represent it in the form of an index, some index. It could be some index. I don't know whether I'll start with it. If I have explained it, just let me know in the class, whether last class or in some previous class I have taught you this. Let's say there is an examination conducted. Just keep the thought aside and now as a fresh thought. Let's say there is an examination conducted. Overall, a few subjects examination is conducted, and someone has scored in that overall examination. Someone has scored 1164. Okay, person A has scored 1164. Person B has scored 1024. Did I ask you a question like this? I told you. In this context, I told you, right? Without knowing out of how much, we cannot judge what is the mark. So similarly, here also, if the base of all these are different, we would not be able to understand what is the extent. So we need to bring all of them into a common base. Okay, here just like we talk about it in terms of percentage to make it all comparable, here also we need to bring all the prices to a common level. So we bring all of these into 100. So this will also be treated as 100. This is anyway 100, but just that was just an example. Or any commodity over there, we will convert it into an index. Just like these marks we convert into percentage, that percentage is an index. Here also we convert it into an index. Okay, and this also helps in another way. Okay, it also helps in another way, in the sense that, let's say here we are comparing between 2019 and 20 to truly understand whether there is inflation or not. We cannot change any of the commodities inside it, quantity as well as quality. You cannot change this at all. See, last year I went to the store to buy a pen. I bought it at 10 rupees. This year I go to a store and buy a pen. The pen costs 100 rupees. We cannot say if it is inflation that is happening unless we know it is the same pen that we bought. Okay, if I bought a normal Reynolds pen last year and this year I am buying a Parker pen, it is not the same commodity at all. You cannot claim that there is inflation. Similarly, last year I bought one pen, this year I bought two pens. Again, you cannot say there is just because you spend more, you cannot say there is inflation. So we need to know that the quantity as well as the quality is the same. Why am I'm sure I have told you this before, but why am I insisting on that again? Here in 2019 and 2020, to make it comparable, we have to make sure that every single commodity in terms of quantity as well as the quality is the same across the 2 years of comparison. This brings with it another practical difficulty, because in a practical scenario, let's say the price of food doubles. The price of food, which was let's say 100, is becoming 200 now. Let's say the price of entertainment, which was also 100, is becoming 200 now. Whatever you are spending on, you have to spend on it. The prices have increased. Now, is it logical to assume that people will continue consuming both of them to the same extent if the salary doesn't become double? Let's say if the salary doesn't become double, will people continue to consume the same quantity of food and entertainment, or will people be willing to give up a little bit on the less important commodity and consume more of the more important commodity? Which means within the basket, there are commodities which are relatively more important and relatively less important. But we cannot make that alteration with respect to the basket of goods itself. We cannot say within the basket of goods we'll bring a variation. Quantity cannot change, then it becomes incomparable. So what we do is, when we create the basket itself, we assign importance to each of the commodities inside. We say food is of higher importance. So if you just look at these, assume that there are only 4 commodities here, and we are putting it into a calculation. We'll say this accounts for 25%, this accounts for 25, this accounts for 25, and this accounts for 25. All of them equal weightage. We say that is not the case. The price, the food accounts for let's say 40%. That is given a weightage of 40%. Whereas this has a weightage of, let's say housing has a weightage of 30%. So 70% is done. So 20% weightage here and 10% weightage over here. Now what happens if the price of food and entertainment rises by the same extent? It doesn't impact the people the same way. A price rise in food impacts the people to a greater extent because they have to spend on food. Entertainment, they can choose to give up on. They can say, okay, I can have less of entertainment, it's okay. For survival, I need food. So to represent that, what we do while measuring this is that food is given a higher weightage. A price rise in food is represented, has a greater impact on the price index, whereas a similar price rise in entertainment has a lesser impact on the overall price index. To ensure that all this is calculated properly, we are converting all of this into index. Food is separately converted into an index of 100. Clothing is separately converted into an index of 100, and similarly all of those. And a value of 40% of that is taken, 20% of this is taken, 30% of this, and 10% of this. And finally, we arrive at a value which is considered as the overall price index. That index for a particular year, let's consider this, okay? How does this index work exactly? Now imagine that overall expenditure on the basket of goods after assigning weightages and all those. Let us say overall expenditure in 2015 is rupees 20,000. 2016 is 22,000. 2017 is 25,000. 2018 is, let's say, 32,000. I'm just stopping it here. Okay. How do we convert it into an index? We are directly going to say 2015 price, we are going to treat it as 100. 2015 price, we are going to treat it as 100. Okay, this is the index. So price has been converted to index. How do we treat it? Nothing, no major complication. We are assuming that 20,000 will be represented as 100. Now the next question is, if 20,000 is 100, what is 22,000? That is what we have to calculate. So in that way, this can also be converted into an index. Very simple calculation. If 20,000 is equal to 100, what is 22,000 going to be? Through cross multiplication, this is in proportions, right? You are doing proportions. You can simply do x is equal to 22,000 divided by 20,000 into 100. You will arrive at a value of 110. You solve this, you will arrive at a value of 110. So if 20,000 is 100, 22,000 will be 110. Okay. Now let's look at 25,000. Now tell me, how would we write it? What would be the equation? What would be the formula like that? Can someone tell me? Someone online can also type in and send. You guys can also. 20,000 by 25,000 equal to 100 by x. Yeah. So x is equal to 25,000 divided by 20,000 into 100, which will give us a value of 125. Correct. Okay. So similarly, if you're doing for 2018 also, it will be x is equal to 32,000 divided by 20,000 into 100. The same formula, which will give us a value of, I think, 160, if I'm not wrong. Yeah, 160 it will give us. Okay, this is how we calculate. So various indices have been calculated now. Okay. Now notice this, at every point when we are calculating it, this is calculated in reference to this particular year. In reference to this particular year. Every time we say, if 20,000 is 100, what is 22? If 20,000 is 100, what is 25? If 20,000 is 100, what is 32? So every time we are referring to this year is what we treat as the reference year, or in inflation concept, we refer to this particular year as a base year. This is considered as the base year for calculating price index. Note that down. Base year is the next concept. In calculation of inflation, to calculate price index, base year is very, very important. Now there is a little bit of a small source of confusion over here. When we talk about calculation of inflation, we say inflation rate is equal to current price minus previous year price divided by previous year price into 100. Okay, this is how we say. So here in calculating inflation, it is the previous year that we take. Previous year is not the base year. Previous year is what we take. Okay, but in the calculation of price index, we do not refer to the previous year. We refer to the base year. Okay, in price index calculation, we refer to a particular year as a constant year. Every time we go and refer to that, and then we calculate it. Okay, so that is very important. Once we calculate this, once the price index is calculated, then the calculation of inflation comes in. What is the inflation rate in 2016? Can someone tell me? What is the inflation rate? Rate of inflation is 2016. Correct. Niral Jyoti, correct. It will be current year price. I am asking inflation in 2016. Current year price minus previous year price. So 110 minus 100 divided by 100 into 100. That will be 10%. So if you calculate the inflation in 2017, it will be 125 minus 110, which is 15, divided by 100 or 110? 110, the previous year. Inflation is what we are calculating here, divided by 110 into 100. Here also we will say this is an increase of 35. 35 divided by 125 into 100. That's how we calculate. So price index calculation is separate, inflation calculation is separate. All this I have not taught, right? Price index I have not taught previously, right? I started with it, but I did not complete it. Have I told you the criteria for choosing base year? How to choose? Did I introduce the concept of base year previously? No, right? Okay, no is the answer there also. Alright. So now we have randomly chosen a year as a base year there in this calculation, 2015. In reality, how do we choose a particular year as base year? Criteria. What should be the criteria behind choosing a base year at the national level? See, imagine a year with extremely high level of inflation. If the prices are extremely high, what happens is that, and we assume that we take that year to be the base year, we take those extremely high levels of prices as equal to 100. The next year the prices revert to the old levels. Okay, so it will be a lesser value than 100 the next year, and subsequent year also the inflation is at normal levels. It will be from this level that the price keeps on rising. So this proves to be an anomaly. If you take a year in which there is excess inflation, as base year, your subsequent calculations, inflation may seem very, very low because you have taken a very high value as a reference value. Okay. Similarly, if you take a year with very little inflation, which is abnormal, let's say abnormally low level of inflation as a reference year, the next year itself, if it gets to normal level of inflation, it will seem like there is very high levels of inflation. Okay. So you should not take a year in which there is abnormal level of inflation, either high level of inflation or low level of inflation, both are bad. So you should ideally take a year with inflation close to the target inflation. So every country targets a certain level of inflation. Whichever country we are talking about, we have already discussed why inflation is a necessity for every country. Okay, so every year targets a certain, every country targets a certain level of inflation. If in a particular year the inflation is close to the target range, then we can consider that year to be a reference year. Now, let me ask you a question just to jog back your memory, just to see if you remember concepts from the previous topic. Okay. Why is it that inflation is necessary in an economy? Business grows, right? Okay. So, a related question. Why is it that a high level of inflation leads to business growth? What is the incentive? They get more money. Okay, good. I'm glad. Online, did you get the question? Did you get the answer? Can you get a few answers? My question was, why is it that inflation is necessary for an economy? That was the first question. Second, so once you give an answer to that. So a lot of generic answers, development of countries, surplus goods to promote. Okay, so there's one answer which Chandramohan has given, which is the same answer that I got here. Why is there a need for inflation? It promotes greater production, to promote manufacturing. My question is, why does inflation lead to a promotion of manufacturing? I've already got the answer from here. Okay, why does it act as an encouragement for producers to produce more is the question. All right, so there are a couple of people who have answered. Yes, because the producers then can sell the products at a higher price. They will produce at a lower price, they will sell at a higher price, and hence a higher margin of profit. So profit is the motive. Good. You always have to understand, when we learn about inflation, you always have to go back and understand why it is important that a country has a certain level of inflation. So here with inflation close to the target inflation, generally years which should not be taken as base year are years with some natural disasters, because then there is a drop in supply, as a result there could be inflation. Some economic reforms have been initiated, like say demonetization or GST introduction, all those affect the price levels in an economy. Such years generally is avoided. Or a year in which we have this pandemic year, 2020 can never be taken as a reference year because it's a very unique kind of a year with respect to prices. All those are not great years to be taken. Election year should not be taken generally at a national level if there is an election, because during election year the government tends to spend more and more on the people, and hence there is excess money supply and there could be inflation. All of these could be criteria behind choosing base year, but ultimately if all of this happens and still the prices remain at the target level of inflation, then you can very much take that year as a reference year. So ultimate idea is a year with inflation close to the target level, whatever else may happen. So in UPSC, if you get a question, which of the following may not be a factor which will help in choosing a year as base year, then being an election year or disasters taking place or a monsoon failure, all of these are years which should, in a general sense, should not be taken as base year, because those can have an impact on demand and supply and hence on inflation itself. Second, it should be ideally a year within the last 5 years, or it should not be longer than 5 or 6 years. Ideally within past 5 years, 5 to 6 years. Why do we say so? Any thoughts? So what? Tax doesn't matter. By how does population matter? Consumption of a household. Okay, fair enough. Okay, so Prashant has an answer, very close. Your answer is also quite close. What's your name? Doctor? Sahana. Yeah, your answer is close. To be very precise, there is a change in the consumption preferences of the people, which means that the basket of goods and services would be changing from time to time. Whether it is due to population change or in general, people's preferences change. Right? What people consume could change over a period of 5 or 6 years or maybe 10 years. Depends. In today's scenario, the consumption pattern of people changes very, very quickly. Maybe 10 or 15 years ago, the changes were happening even at a slower pace. Right? So in the present scenario, once in 5 years are ideal because the basket of goods may otherwise drastically change. What is the point of calculating the price levels using a basket of goods and services which is not even relevant to the current consumption pattern? Which is why we say ideally it should be within the past 5 or 6 years, the base year. Okay. Similarly, we also have to ensure that it is not too close to us. In 2021, assume that 2020 was a very ideal year. No issues had happened. Even then, we cannot take 2020 as a base year. Why? No, I said assume it to be a normal year. No pandemic had happened, let's say. Even then, not an ideal year. Production was affected due to pandemic, right? I'm saying assume that. Okay, consumption pattern is same, so that is ideal, no? That is good, no? Consumption pattern being same, because then it becomes easier to compare. Okay, I'm most of the answers, yeah, correct. So Prashant again has the answer there. The answer is that if the year is too close to us, we may not have all the sufficient data. Data collection is a little slow with respect to all these things. Okay, so if you want all the data, it has to be a year which is at least a couple of years behind. So 2 years back, and from there 5 years. So that is the ideal. So that is why maybe if you are going to choose a base year right now, maybe we can choose 2018 as a base year, or maybe 2019 as a base year, not 2020 because of all the pandemic issues that were there, not either 2017 because GST was introduced during 2017, demonetization in 2016, all those created a lot of uncertainty in the economy. Maybe even 2019 is not great because, as you were saying, there was economic instability even before that, drop in production in the manufacturing sector and in a lot of other sectors also, that is there. But comparatively, if we have to compulsorily change, currently we are following predominantly a base year of 2011-12. Okay, 2011-12 is 10 years back. So we need to change. It's already high time to change. If we are changing it, there is a possibility that we might change it to 2017-18 or 18-19. Okay, we would have definitely changed it if not for the pandemic. But now in the context of pandemic, again we'll have to verify. The organizations which are in charge will have to verify which is the ideal year for calculations and all those, and then you have to do. So it should not be too close. What I mean to say is that should not be too close. I'll also write the reasons. Should not be too recent. Data sufficiency issues. Here ideally within past 5 to 6 years. Relevance of basket. So these are the criteria for choosing base year. Who decides the base year? Asks Helen. So whoever is calculating the price index, they are the ones who choose the base year. Different price indices are calculated by different organizations. I'll give you an idea when we get to individual price indices. We will be discussing about, say, something like consumer price index, wholesale price index. Each of them are calculated separately. So each of them are calculated by different organizations. They individually decide what is the price index for each, or base year for each of those price indices. So there is no common one answer as to what is the ideal or who chooses or anything. Okay. Just one more concept relevant to this in the calculation of inflation. I'm teaching it now because of a possible confusion. There's a concept called as base effect. I'll define it as, you can write it as a definition, the impact of previous year's prices, on this year's inflation calculation. The impact of previous year's prices on the current year's inflation calculation. The impact of previous year's prices on the present year's inflation calculation. That is what is base effect. You can write as a note over there, this concept has nothing to do with base year. This concept has nothing to do with base year. We were discussing base year so far. The word base here refers to the previous year. The word base here refers to the previous year. I'll explain with an example, then you will understand. Okay. Imagine two economies, A and B. 2019, 2020, okay, enough. Okay, 2021 also. Okay, let's say the price in both A and B, the price index in both A and B was 100. In 2020, it increases to 120, it increases to 150 over here. Okay, the price index increases to 140 here, it increases to 170 over here. If you look at what is the change in the index here, it's 20, the change in the index here, it's 20, the change in the index here is 50, the change in the index here is 20. So in three places, the prices are increasing by 20 points. Okay, if you are talking about it in rupee terms, price is increasing by 20 rupees here, 20 rupees here, 20 rupees here. Here alone it's 50 rupees. Now, what is the inflation rate in 2020 in the economy A? What is the rate of inflation? Did someone answer? What is the price, inflation rate? This is the price index, let's say. 20%, correct. So it's 20% here. What about here? 20% again? Okay, forget the right answer. Is it 20 or is it not 20? It's not 20. Okay. So 140 minus 120 divided by 120 into 100. So 20 by 120 into 100. Earlier it was 20 by 100 into 100. Here it's 20 by 120 into 100. You will get a value, thanks to Chandra Mohan, 16.66%. Okay. Here in this economy, the inflation here is 50%. 50 by 100 into 100. That's 50%. Whereas in this case, 20 by 150 into 100. So would be 13.3 if I am not wrong. Yeah, around 13.3% or so. Now look at this. There is a price change of 20 rupees here, price change of 20 rupees here, price change of 20 rupees here. But three different levels of inflation in each of these three situations. Why? Because in the formula for inflation calculation, we use as the base the previous year. Okay, the previous year's price is different here, the previous year's price is different here, the previous year's price is different here and here. So you will find that there are different inflations. For the same change of 20, there is an inflation of 20%. For the same change of 20, there is an inflation rate of only 16%. For the same change of 20, there is an inflation rate of only 13.33%. Now, let's just compare these two. Because the previous year, the price rise was so high, the previous year's prices was so high. Last year there was an extremely high level of inflation, so the price was high, as a result of which the present year's inflation seems very low. You're already at a very high level, so from here if you are growing, because you are comparing with this level, this seems like a lesser growth as compared to last year. If the growth was small and from there you have the same level of growth, it will seem like a higher one. So the impact of previous year's prices on the present year's inflation calculation. Similarly, forget the entire thing. Here itself, there is 100, there is 120. So the prices have increased. Because the prices have increased here, this inflation is seeming like a lesser inflation than this, although the price rise is the same. Okay, this effect is what we call as base effect. It is independent of the base year concept. It is not a base year concept. Here the word base refers to the previous year in the inflation formula. Okay, so because the formula itself is this year minus previous year divided by previous year, if the previous year has a very high level of inflation, the rate of inflation might seem smaller. If the previous year had very small level of inflation, this year's inflation may seem higher. So that is how it would vary. Okay. Any questions on this? You guys have any question? Guys online? Chandramohan has answered saying no questions. Anyone else? Alright. Okay, thank you. I'll proceed then. So we'll talk about different types of indices that are there, price indices that are there. I'll not be able to discuss every single price index that is there, but I'll discuss the major ones. Okay. So we have something called as wholesale price index. Okay. So by wholesale we mean the business side. By wholesale we mean the business side. Now, whatever we have seen so far, we have come across the basket of goods concept in many places in the beginning of today's class. In the last class, when I introduced inflation to you, I would have mentioned about the basket of goods. I remember mentioning basket of goods and services in purchasing power parity, second chapter when I taught you about purchasing power parity. Do you remember? There also I told you about basket of goods and services. There I said basket of goods and services, how much is the expenditure in one country versus how much is the expenditure in another country. That is what I was doing in PPP. In inflation, what we do? On the same basket of goods and services, how much is the expenditure in the previous year versus this year and any subsequent year. That is how we calculate. So basket of goods and services we have used in many places. Most of the times what I have given you is a basket of goods and services which is relatable to us as consumers. When we go to store and buy, what are the things that we buy? But we are not the only entities which are purchasing goods and services in the country. The businesses also purchase goods and services. So from their perspective also, inflation is very important, because inflation for their production needs to be at a control level. For them to have high levels of profit, CPI should be, consumer price index should increase, but wholesale price index should be comparatively lower. Only then that can they produce at a lower level and sell at a higher level. You remember we discussed inflation is to make profits, right? Inflation enables them to make profit. For that profit to happen, sales should happen at a higher price, but the production should happen the old price itself. So we need to monitor what is the price levels at the producer's level as well. This is also sometimes referred to as producer's price index. Okay. But now we are trying to introduce a whole different index called as producer's price index. It is not there yet. Sometimes it is referred to as the producer's price index also. So specific details of wholesale price index, what are the weightages? Here also we have a basket. Interestingly, this is not a basket of goods and services, it is a basket of goods. It is a basket of goods, not goods and services, which means services are not included here. Okay. So this basket of goods consists of three major criteria. Number one is primary articles. Number two, we have fuel, light and lubricants. Number three, we have manufactured items. So essentially this is like the primary sector, in the agricultural output that comes in, that is what we are referring to as the primary articles. Okay. Then this is the secondary, out of mining, the coal that comes out and all those which acts as fuel and lubricants, the crude oil imported and all those would come inside this. So this is a separate category which could be a mix of primary and manufacturing as well. Refined products also come here as long as they are fuel. Okay. So it's a mix of primary and secondary. Primary plus secondary. This is entirely secondary level activities, whatever comes out of the industry. That is what is represented. Interestingly, service sector is not represented here. That is why I said it is a basket of goods alone, not a basket of goods and services. Now, why is a very dicey question, but we can try to answer the question why. I've told you in previous places also, for a very long time, it was believed that services do not contribute much value addition. Services only help in the production of goods. That was the belief, widely held belief. I remember I told you in public finance class as well, right? Till 93, 94, we did not even tax services. Service tax was not there in India because services were such minuscule and they were not value generating on their own, was the belief at that point of time. This is a representation of that belief also. The second issue with respect to services is that it is very difficult to price services. It is very difficult to price services. How do you put a price to services? With production of goods, you can say what is the input cost. So add all the input cost and a small margin of profit, acceptable margin of profit, and you say, okay, this is how we derive at the price. But for services, how do we derive at the price? So I come and teach here, how do we decide what is the expenditure on me? It varies based on my level of seniority, based on the demand conditions in the market, a wide variety of factors. So I come in, the expenditure on me might be different, on a different faculty it would be different, teaching the same things at the same effectiveness, it may be different. Okay, so all those variations would come in. So with services, pricing was a tricky issue. Exact pricing was difficult. So they left out services from this whole thing. So wholesale price index consists of these three items and in different weightages. What are the weightages? You will find it in the textbook. I'm not going to go into those specific facts. These weightages could vary from time to time. If the government decides to make a change to weightages based on their importance in the economy, that could vary. But essentially, these are the three major headings. There are about 600 or 700 items inside this under the various categories. Okay, there are so many items inside this. So this is wholesale price index. From a business perspective, what are the price levels? Okay, this particular price index is calculated and released by the Office of the Economic Advisor. Office of the Economic Advisor. Under the Ministry of Trade, Ministry of Commerce or Ministry of Trade, whatever, it's all the same ministry. They have chosen as base year 2011-12, which might change sometime in the near future. Would it change every year? What is the point of having a base year? If it changes every year you are changing the reference of 100, then what you are doing is every time you are comparing with the previous year, right? It will not change for a period of time, which is why I am saying it should be, so when I say this point, what I essentially mean over here. So ideally within the past 5 to 6 years, what I mean is that every 5 to 6 years the base year needs to be changed. That is what I mean by this. So now let's say we introduced 2018 as the base year. It will continue for the next 4 or 5 years and after that we'll change. Because it was introduced 2011 and 12, it was changed from, previously it was 2004-5, from 2004-5 it was changed to 2011-12 only in 2015-16. Okay, so about 5 years ago was what? It was changed to 2011-12. In 2015-16 or 14-15, whenever they made the change, they felt that the nearest year where sufficient data was available, which was a good representation of the current consumption of goods and services, where the inflation levels were normal, was the year 2011-12. That is what the organization calculating it felt. So they fixed 2011-12 to be the base year for their calculation. For them, that was the best year. Okay. Now the organization will again do an analysis to find out of the previous years, any year after 2011-12, ideally let's say post 2015-16, which year is the best year suited to be the base year. So they'll analyze every year, 2015-16, 16-17, 17-18, 18-19, 19-20, all the years they'll analyze, and whichever year fulfills those criteria, the 3 criteria that I said, they can choose that year as the base year. It might seem like this is very old, 10 years ago. That is the reason you ask, right? It is because it was set only in 2015-16. Only 5 years ago it was set. Okay. Ramesh is asking an interesting question. Ramesh, I'll answer that question in a little bit. Okay. If I had seen that question a little earlier, I would have answered. Now I'll wait till I finish this concept and then I'll answer the question. Okay. So this is wholesale price index. Now, in India, we have a target of inflation. There is a certain level of inflation that we are targeting, and I'll tell you about it in the end, but there is a certain level of inflation. 4% inflation is something that we are targeting. We believe, our country, our government, Reserve Bank of India, all of them believe that if India overall has an inflation of 4%, it is actually good for the economy. This inflation is to an extent where it will promote the producers to produce more. It will also not harm the consumers much. We remember in the last class we said creeping inflation. This would come under the category of creeping inflation, where people don't feel the inflation but producers benefit from the inflation. So this target is there of 4%. Now when we say inflation is to be calculated, you know that inflation will be calculated from the price indices, various price indices that are there. So we just spoke about something called as wholesale price index. Okay. There is also something called as consumers price index too, from the producer side, from the consumer side. Okay. Interestingly, from 1947 when we got independence, and even before that till 2015, the inflation target was calculated, the target inflation, find out whether we are achieving this or not, this target of 4% or whatever was the target. At different years we had different targets. We have had years of 10% target of inflation and 12% as well, very high levels of inflation. All those targets have been based on wholesale price index. Okay, the target of inflation was based on wholesale price index. From 1947 to 2015, we were targeting inflation. Whenever the government said we are going to reduce the inflation or we are going to increase the inflation further, every time we were targeting only wholesale inflation calculated from wholesale price index. Okay. Now there are some inherent issues with respect to using wholesale price index as the source of calculating inflation. Number one, does not reflect consumer prices. Now this is where you have to do a little bit of linking as well. Do you remember the formula for GDP, the expenditure method formula? Can someone tell me? I'm waiting for you to answer. Expenditure method, GDP, without turning back. Think, there are only 3 ways of calculating GDP: product method, expenditure method, income method. What are the different types of expenditure? Who are the entities which spend? Think of the circular flow concept. A household. Household expenditure is referred to as? Correct. What? Consumption expenditure. C plus I, investment expenditure, plus government, G, plus X minus M. Now why am I talking about this? This is GDP. This is the GDP of the country. Close to 50% of the GDP is through consumption expenditure. 50% is through consumption expenditure. Okay, which means consumers the money spent by them contributes to 50% of India's GDP if you are calculating it by the expenditure method. What is the business expenditure here? I is the business expenditure. Their investments in buying raw material, in buying all those three categories of things. So WPI is a representation of this I. Whereas your consumer price index CPI would be a representation of this C, consumption expenditure. Okay. Consumers are the ones who contribute 50% of the GDP when we calculate by the expenditure method. In spite of that, we are not considering the consumers, we were not considering the consumers, we were considering the producers' prices and calculating the inflation or in targeting the inflation. So that was a criticism that was there. Okay. All of you have heard the statement, right? India is a consumption-driven economy. China is a trade-driven economy. India is a consumption-driven economy. China's economy is driven by this X. Consumption by a foreign household. China's economy. India's economy is driven by consumption of the domestic household. C. That is what drives our economy. Okay. So consumer prices are very, very important in driving the economy. We were not considering that for calculating inflation. We were calculating based on the wholesale price index. That is criticism number 1. Please note it down. Nirmal, I'll answer your question also in a little while. Second, WPI ignores services. Services which contributes to more than 50% of India's GDP. The price levels in services is ignored in WPI. Because I told you it's not a basket of goods and services, it's just a basket of goods. It does not consider the service sector at all. For whatever reason, whatever their logic is in calculating that, they are not including it. Okay. So these two were criticisms of calculating inflation through WPI. So obviously it becomes very evident that we have to use something like a consumer price index to calculate inflation. If it is so evident, why is it that till 2015 we were still continuing to calculate inflation based on WPI? Any idea what it could be? So the issue is not with some great thing about WPI. There is some weakness in CPI, in calculating CPI. There is some issue with using CPI. Which? Why? Consumption? Why? No, but we are not going to every household and calculating, right? Because consumption expenditure you can calculate from the market level itself. Nishchit says lack of data, not quite. Tax, so what? Compensation, GST compensation. Correct. So that input tax credit concept. So what? How does it affect? Consumer pattern changes from time to time. Consumption pattern. Rather than it changing from time to time, at the same time, does everyone in India consume the same way? Is the consumption pattern of Tamil Nadu the same as consumption pattern of Kerala? Is the consumption pattern of southern India the same as the consumption pattern of, let's say, people in western India or eastern India or northern India? No. So when we say, see, in purchasing power parity itself, we discuss the same concept. How can we compare the purchasing power of two countries by using the same basket of goods and services? Because the consumption, what gives a good quality of life? The commodities which give a good quality of life would be very different for an Indian in comparison to an American. Then how can you compare? That was a question there. The same question here also. When you are comparing the price levels using what consumers consume, the consumption pattern is very different in different regions of India. Forget Tamil Nadu and some other region. Within Tamil Nadu, the consumption pattern in rural area was consumption pattern in urban area is very, very different. That was the reason why it was very difficult for any entity to come up with a pan-India consumer price index. It was not possible. To come up with one basket of goods and services for entire India was almost impossible. It is still impossible. We still do not have something like that where we have one basket of goods and services. But at that time, we had, I'm talking about the past, we had 4 consumer price indices. CPI, the major heading is consumer price indices. We had a CPI for agricultural laborers. Sorry. We had a CPI for agricultural laborers. We had a separate CPI for rural laborers who are non-agricultural laborers. People who are working in rural area but who are not engaged in agriculture. Now, why do we bring about this difference? Because the quantity of food, the kind of other expenditures that they make would be very different for people working in the farm versus people in rural area who are not working in the farm, who are engaged in other kinds of occupation within the rural area. It's very different for them. So, a different basket of goods and services here, a different basket of goods and services here. Then we had something called as consumer price index for industrial workers. So this is in the urban area for people engaged in manufacturing activities in the industry. And we had something called as CPI for urban non-manual employees. This is mostly people in the service sector or people doing administrative kind of job or banking and those sort of activities. Okay, so that is what these are. Now these three, see, all of them have a different basket of goods and services. Okay, so these three were calculated by the Labor Bureau. Thanks. These were calculated by the Labor Bureau under the Ministry of Labor. In fact, they believe that the consumption pattern has not changed significantly. The basket of goods and services have not changed significantly. So some of them even have base year as far back as 1984. Okay, I'm not sure exactly which one is 1984, but there was a change made very recently in last year in one of these. So I suggest that you just Google and find the base year for each of these three things. Okay, so if there is no change, so Niral Jyoti asked a question. I think it's a good time to answer that question. What is the necessity to change base year? In fact, there is no necessity to change base year if there is no change in the basket of goods and services. Okay, and if there is no significant, variation in prices. There are two reasons why we need to change base year from time to time. One, the basket of goods and services may vary. The actual commodities consumed by the people may vary. Second, if we do not change the base year for a very long time, you will see very high levels of base effect. You will see very high levels of base effect because this number will keep on increasing over the years, and then you will start seeing numbers like 300, 320 and all those. Now imagine the numbers of 2 years are 300 and 320. Now you would say 20 by 300 into 100. So that will be the level of inflation. So inflation would be something around 6%, 6.66%. 20 by 3 would be around 6.66%. Same level here, 20% inflation, this is 6% inflation. Why is this happening? Because the base is continuously increasing. Previous year's price levels is continuously increasing. Why is that happening? Because we have not reoriented the base year to 100 anytime recently. For the last 20-30 years, if we keep using the same thing, the number will keep on increasing and we will start seeing very high levels of base effect. Okay, I think this is a good time to answer Ramesh's question as well. So Ramesh has asked a question, what is the need of this concept of base effect? What is the importance here? Now there might be some year where we find that the inflation is very, very high during a particular year. Inflation rate is very, very high. Okay, then we can investigate into whether last year the inflation was very, very low. Because if last year there was either low inflation or in fact deflation. Deflation is the opposite of inflation. If the prices had dropped, if any of this had happened, even a small level of price rise may seem like very high levels of inflation in this year. Okay, so When we calculate the number, we wouldn't know that. So when we see high or low inflation numbers, we can go back and check whether there is a possible base effect inside it. If there is a base effect, then we can re-understand the inflation. A very high level of inflation may not be really bad if the last year there was a deflation. Okay. Similarly, a very low level of inflation should not give us a false sense of security. Oh, inflation is very, very low, only 6%. It is showing a 6% because of base effect. Because the last year's price level is already so high, inflation is seeming to be lower than what it really is. Okay. To give us that understanding, the base effect is very, very important. I hope, Ramesh, your question has been answered, and Niral, I hope your question has also been answered. Okay. Okay, so someone has pointed out, Helen has pointed out that the CPI for industrial workers was changed to 2016 in the last year. So I know some change was had happened. So apparently it's been changed. Please check for the other also. Please verify this also on your own. Okay, so this is how these three are calculated. CPI for urban non-manual employees was calculated by this organization called as Central Statistics Organization, which has been renamed as National Statistics Organization now. But since 2015, they have not been calculating this anymore. So this data is not there anymore. This CPI is not calculated anymore. These three continue to be calculated. Even today, it is there. Labor Bureau continues to calculate it. Yeah, good that you asked that question. Now, if we do not change the base year for a very long time, what happens? The previous year's price index is very, very high, right? So, if you change the base, say base year every 5 years, the price index is again set to 100. Okay, so let's say 2011-12 is what we are using as the base year. So 2011-12 prices will be 100 and subsequent years will be calculated. Now let's say 2017-18 is set as the base year. Then 2017-18 prices will be set as 100 now. Let us say if there is no change in base year at all, then 2017-18 prices would be somewhere around, let's say 180. Then 2020-21 prices will be 200, something like that. The prices will keep on going like that because there is no reset to that 100 point. Now, as a result of that, what happens when you calculate it, your denominator becomes bigger and bigger. This denominator is nothing but the previous year. Okay, that is why when you do not change the base year, the base effect tends to be more pronounced. But the reason I did not mention this earlier is you are just getting introduced to the concept. If I bring you this level of complexity, you will get all the more confused. Okay, you noticed it, you asked me the question. Normally what happens? I teach, then you go back home. Most people don't go back home and read. Some people go back home and read, then they get this question. This question is something that normally comes in the subsequent class, and then I clarified. There is some time for you to understand the concept and think about it. Now, since you asked, I am telling you, in calculating the base effect, or the effect is not seen as a result of base year. The base year refers to the previous year. That much I assume you have all got it clear. But because if the base year doesn't change, the previous year's value keeps on increasing. This 200 subsequently will become 210 or 220, subsequently will become 230, and one day it will become 300, and one day it will become 400 if there is no change in the base year at all. So eventually, this denominator being high will reduce the value of inflation. That is what is base effect, right? So that is what I am trying to convey over here. Even now, I still stand by the statement that I made earlier. Base effect and base year are unrelated concepts. Okay, even if you do not have a concept of, let's say, base year, if the previous year's prices are high, you will still see the base effect. Okay, so what changed in 2015? India decided to move to a different sort of a regime. In 2015, it was decided that the RBI's primary role was changed from, RBI had many roles, multiple targets they had. Their roles included money supply, managing the money supply in the economy, managing the exchange rate in the economy, managing India's trade position, all of those, forex reserves, all of those were given equal importance. 2015 onwards, they said RBI's primary role in the economy should be to manage inflation through their monetary policy. The main focus of monetary policy should be to manage inflation in the economy. That was a target that was set. Okay, and there was something called as a monetary policy committee which was set up. Monetary policy committee was set up, and that committee would do whatever measure is taken to manage the inflation at a particular level. That committee, they came up with the decision that we should not follow wholesale price index. Instead, we should follow a consumer price index to keep this target. They are the ones who set the target to be 4% inflation as ideal inflation. So CPI should be the means of calculating the inflation. But then came the question, if you are going to use CPI, which of these CPI will be used? This will be a different price index, this is a different price index, this is a different price index, and this is a different price index. That is when they said, we will not follow any of this, instead we will introduce a new price index. So again, National Statistics Organization, NSO, in 2015 introduced a new set of price indices called as CPI Rural. For the whole of rural India, they came up with one basket of goods and services, and CPI Urban. For the whole of India, urban India, they came up with one basket of goods and services. Okay, so this is all that they calculated, and then they said, because we want a pan-India index, we will just mathematically combine these two, and we'll come up with another thing called as CPI combined. Because their intention was always to combine here, they came up with similar basket of goods and services. For example, there are 6 items in this, there are 5 items in this. All the 5 items here are also here. One item which is missing here is rural households do not spend on housing. In urban area, there is expenditure on owning a house or expenditure on renting a house. In rural areas, you wouldn't see a lot of concept of renting of houses. People mostly stay in their farm or their own, they own the household that they stay, or they build a house wherever they are working. That is what that normally happens. Generally, in rural areas, there is no renting out of houses. People don't spend much on housing. That alone was left out. The remaining 5 items were maintained as it is, but the weightages were different. Out of their overall expenditure, what percentage was spent on food was higher over here, was lesser over here. Those sort of changes were brought about. Okay, and mathematically, all those 6 were combined into this combined, where the weightage will become half, because one entity does not use housing, one entity uses housing. So eventually a combination is done, and an average is brought about here. So it is a mathematical concept where they have combined the price indices. CPI combined was released, and based on the CPI combined, they calculated the inflation. So this is one index of 100, 110, 120, 130, whatever it is. From that, the inflation was to be calculated. It is. Services are included here. So if, do you guys have this book with you right now? No? This book you have at home at least, right? Okay. Page number 49 in this book. I can't show it over here. If you guys have it at home, you can take a look, or you guys can actually pass it on and take a look at it. You have the book with you? Okay. You have it? No? You have a soft copy of this. Take a look at it. You will see what I'm talking about, and then pass it on. Once you are done, just give me back the book. People at home, you can take a look at your book, page 49. You have this particular index that is given. There is one area where they say CPI, this is CPI urban, you will see, CPI rural, you will see, and then you have CPI combined. Once you have taken a look, you can pass it on to. If you are interested in seeing, if you are not, you can let it be. Page 49, Karthik. So Niral asks, but high inflation is problematic to government, so they can see less inflation without changing base year. Yes, they can, but then easily it will be pointed out by everyone else that the inflation is low because they have not changed the base year. So the government will not be able to use this as a tactic to show less level of inflation. They will easily be found out. Hope that is clear, Nerul. That okay. You can take a picture if you want. Any questions on this? Yes, that is Shankar Academy book, Radhakrishnan. The brown book that you would have got. Yes, Uninga. Strange that alcohol is not included. Alcohol is definitely included. Who's finding it strange? Okay. There is a category called as pan, tobacco and intoxicants. There is another category called as food and beverages. Okay, in beverages you only have non-alcoholic beverages, right? So I think that will be included in the category of intoxicants. For those who are really concerned, yes, they do include intoxicants into this. Yeah, so part 1 is what I am referring to, not part 2. Ramesh, part 1 is what I am referring to. Alright, couple of other questions. Helen is asking, what is a retail price index? Retail price index is the opposite of wholesale. Wholesale, retail, right? So what is the opposite here? Retail price index is another name for consumer's price index. It's nothing different, it's the same. Retail price index is another name for consumer price index. That's to answer Helen's question. Then GV is asking, why rural accounts for more than urban? I don't understand what you mean by accounts for. I'm assuming your question is, why is rural price index higher than urban price index? Is that your question? Most weightage seems to be on rural side. No, there is nothing like that. If you look at it, food and beverages. Yeah, so why is it that the weightages seem to be higher on the rural side? Because housing is as a category, 21.67% is missing, right? So the question is not about, the weightages don't mean anything. This is how the question is. If rural is spending 1 lakh rupees and urban is spending 1 lakh rupees, what are they spending on? In urban, so this is rural, okay, this is urban. In urban, they have an expenditure on housing. So of their overall expenditure, even if they are spending, let's say, a higher amount, in this case, if you are talking about 1 lakh, you wouldn't see, let's say in urban area, the expenditure is 2 lakh. In rural area, the expenditure is only 1 lakh. Let's say. They might actually be spending more on food, but because they are spending more on housing also, their expenditure on food seems to be a lesser percentage. So don't worry about the weightages. The weightages being higher in the rural is only because in rural there are only 5 categories. The entire 100% has to be split among 5 categories. Whereas in urban there are 6 categories. The 100% is split among 6 categories. That is the reason why you will find that in rural areas, food and beverages is a higher weightage, clothing is a higher weightage, fuel and light is a higher weightage, and miscellaneous is actually a smaller weightage, slightly lesser weightage. Why? The 21.67 that you see in the urban area, number 4, housing, that has to be split among the rural, other areas. They only have 5 categories to split it into. Of their overall expenditure, food, the percentage that they spend on food is 54%. That is what it means. Okay. Alright, great. That is understood. On, okay, Ashwin's question, sir, on what basis India buying crude oil and selling in our country too high to us, sir? See, I told you this concept when I addressed GST, right? Features of GST. So I told you that certain commodities are kept outside of GST, are not included in GST. They are excluded from GST. Fuel being one of them. The reason fuel is kept outside is because in case there is a sudden rise in international crude oil prices, it shouldn't affect the people significantly. So they said we'll keep it outside of it. But that itself is coming to harm us right now because the government is collecting a lot of taxes. Internationally, when the prices are going up, okay, internationally the prices are actually going up a little. You might see from here and there that it is not, but it is internationally going up. OPEC, the petroleum producing countries, they have formed a group. They are artificially raising the prices at which the fuel is sold. In India, because we have multiple levels of taxation, both the center as well as the state, both are taxing fuel. Okay, so as a result, the government is not yet willing to reduce taxes because government is short of money because of the COVID situation. Government is not getting money from other sources. They are not as ready to reduce the taxes or surcharges on fuel. Internationally also the prices are being prices are increasing. So that is the reason why it is happening right now. So what is the basis? Because the government requires money. If the government wants to spend it, they are collecting taxes, both the state and as well as the center. If it becomes too much, even now, if you look at it, there are voices being raised, but then people are more or less okay, used to the fuel situation. We don't see a protest like the farm protest or something like that. We are at a situation where only if there is a huge protest, government will do something about it. So as long as that doesn't happen, it is likely to continue. It can ease automatically. This government has been very fortunate in that case. Whenever one issue has come up and it seems like, oh, the government is going to be in trouble, some other distraction comes for the people, some other big issue comes and everyone forgets about this issue and move on. So similarly with fuel also, that is likely to happen. Something or the other will come and distract people from the fuel price. Maybe the price itself, internationally the price itself may drop. There might actually be a good news for us. The sanction on Iran, if it is lifted, we might start importing oil from Iran once again, which will significantly reduce the price of oil because the transport distance is very low. Iran tends to sell oil cheaper than others because very few people buy from them. For India, the closest source of oil is from Iran. So if that happens, once again, the prices may come down. Okay, so we'll wait and see. All these have a lot of politics as well. Okay, so yeah, Karthik says OPEC have mentioned yesterday that they will reduce crude oil prices. So if they reduce, yes, once again the government gets saved over there. Okay, moving on now. This is done. Okay. Now, based on these price indices, we also have this basket of goods and services. We also have another concept. So types of inflation again, not as a major heading. So types of inflation based on items considered. So we have a concept called as headline inflation. We have a concept called as core inflation. Okay. Headline inflation is another name for normal inflation. It's just a name for another name for inflation. Now, why do we specifically have something called as headline inflation? Because we have a concept called as core inflation. What is core inflation? Inflation calculated after ignoring volatile items from basket. Core inflation is inflation calculated after ignoring volatile items from the basket. Generally, what are volatile items? Volatile items is where prices fluctuate very frequently. Those are volatile items. In a basket, generally the volatile items are number one, food prices, your agricultural products. The price of onion or tomato or all of these things vary on a daily basis in the market. Someday it goes up, someday it comes down, it keeps fluctuating. Very similarly, fuel prices also fluctuating in nature. They are volatile, they may go up, they may come down. The prices which are non-volatile in nature, you buy any commodity which comes out of an industry, it comes with a packaging, with a printed price. the price of those commodities do not change over time. Okay, they tend to remain the same over a period of time. Take a packet of biscuit or a packet of coffee powder or a pen or a computer and all those things. The prices tend to remain the same over a long period of time. Once they increase, they do not come back again. Once they increase, they always remain increased. The price of pen increases from 10 to 12, never will it come back to 10. It will always be 12. After that, it will remain 12 for a very long period of time. Maybe they will increase to 15 after some time. But it will only see an increase. So it remains stable. Manufactured items have a very stable level of prices for a period of time. If they increase also, that is a stable level. So to find out if there is inflation in the country, what level of inflation is stable inflation and what level of inflation is unstable, which is temporary inflation. It's temporarily there is inflation, it may come down in future. To understand that, we have two classifications. The normal inflation that is calculated is called as headline inflation, because the volatile items are included here, which means that it tends to make headline. It tends to come in the news. If this inflation increases or decreases, it tends to make the news. So headline inflation. Whereas core inflation, you remove all the volatile items. Food, fuel, anything else you consider volatile, you remove it. Only the core items where the prices remain stable over a period of time, only that is included. So talking from a WPI perspective, there are three things: primary products, fuel and manufactured items. Headline inflation consists of all three. Core inflation ignores the primary products and fuel, it only includes the manufactured items. That is inflation calculated that way is core inflation. Yeah. It will be based on the MRP, because MRP is what your indication for actual prices, right? What is the price set by the companies? Who sets MRP? Business or government? Businesses set the MRP. You know that, right? Only for some essential commodities, the government will say this is the maximum price at which you can sell. They will set a cutoff. Like during the pandemic, they said your hand sanitizers were sold at 300 rupees for a small bottle and all this. Government came and said, no, you cannot do that. There is a maximum price that they are going to set. Those are essential commodities. For all general commodities, it is the company itself which will set the MRP. So that is the guiding price. After that, the retailer may sell it to you at a lesser price, cannot sell it at a higher price. It's illegal. That is why you have something called as MRP. So it will be set based on the MRP, okay, which is inclusive of the taxes. In WPI, you may not have taxes also. So the impact of taxes also ignored there. In CPI, you have the taxes included as well, because that is what people actually pay, right? Okay, Chandramohan is saying, but there will be an impact in core inflation even though volatile items are removed. Example, transportation cost for non-volatile items. So Chandramohan, your point is very valid. So Chandramohan says for non-volatile items also, the transportation cost may, and transportation cost includes the fuel price. So that may actually have an impact on the prices. When you say manufactured products, it comes with a pre-printed price from the market. So that is what we were just discussing. There will be a pre-decided price. The company, just because there is a sudden change in fuel prices, will not increase or decrease the prices. Okay. There is something called as sunk cost, okay, or a menu cost. There is something called as a menu cost that we say in economics when it comes to inflation. What is a menu cost? If the prices of something changes, let's say the price of onion and all those changes, okay, a restaurant which is running, they might have to change their prices as well. The price of their commodities, of their food items may also have to change. Something that they are selling for 200 rupees, they may have to sell it at 210 or 220. They might have to do that. But a lot of times they do not do that. They decide to wait for some time to find out whether this actual onion price rise or tomato price rise is there to stay. Why do they do that? Because if they have to change the prices, they have to change their entire menu, the printing cost of the menu, and everything changes, which is very costly for them. So they say, we'll suffer a temporary loss in our profit range and we'll not change the prices, because people will look at the menu and think that is the price. In some restaurants, you will find stickers being stuck because onion prices have risen. All the commodities will be sold at 10 rupees extra. Why? They don't want to spend extra money on changing the menu itself. So there is something called as menu cost. Because there is a cost, manufactured items and things that come out of the company, they suffer that loss instead of changing the price itself. For them, imagine, let's say a Maggi packet comes at now 12 rupees it comes at. Imagine that the prices have risen, transportation costs have risen, and they have to increase the price of every single Maggi packet from 12 to 14. They cannot sell a packet which is printed at 12 rupees at 14. It is illegal. So they have to pull back all of those. They reprint and repack. All this is too much of expenditure for them. So on manufactured items, when it comes to MRP, even the transportation cost price or change may not impact the prices. That is why we call it as core inflation. Only if it is sustained over a period of time, in the next batch, the price may have gone up. And once it goes up, it remains at that level. So to answer the question that Chandramohan has asked, the impact of fuel and transportation cost on the core items is very, very minimal. What is the purpose of calculating core inflation when most of the important items are excluded? Helen, so if you have the textbook with you, okay, if you have the textbook with you, go to page number 47. So Helen's question is, what is the importance of calculating core inflation when most important items, which is food and fuel, are ignored? If you take a look at that, you guys don't have it. I wrote something like this, right? I'll write it here so that you guys can take a look at it. Primary articles consists of 117 items. This consists of 16 items. This consists of 564 items. Here the weightage is 22.62%. Here the weightage is 13.15%. Here the weightage is 64.23%. Now take a look at it and tell me, Helen, are these the more important things, or is manufactured items the dominant entity over there? So core inflation takes into consideration only this, which is anyway the dominant entity over here. 564 out of the 600, 700 items that are there. That is the key entity. The other two consist of a lesser number. Okay. So it is our perception that this is less important and these are more important. The reality is this is a major number. It will be helpful if you can bring the book to class from the next class. It will be beneficial. Okay. So do we take a break or do we finish just one more concept and then take a break? It's already past the halfway mark. We'll take a break. We'll take a break for 5 minutes and we'll come back and continue. Okay. We'll continue. In some restaurants, they keep same price, but they put very low quantity or no quantity of onion in our dish. Very true, Karthik. You'll actually see that's an interesting observation with respect to price rise. You'll find that dairy milk, right? The smallest dairy milk that is there, 5 rupee dairy milk. It has been a 5 rupee dairy milk for a very, very long period of time now. Just that when it started, this used to be the 5 rupee dairy milk. Then it decreased to this being a 5 rupee dairy milk. And now it is only this being a 5 rupee dairy milk. Initially there used to be 4 blocks, then it became 3 blocks, then it became 2 blocks, now it's 1 block. So this is also inflation. What they are doing is instead of raising the price, they are giving lesser quantity. That is also inflation. So that's also a good observation. So that can also be used as a countermeasure to overcome price rise. Right? And we may not even initially even notice that this is happening to us. We wouldn't probably notice that this decrease in size is happening. Okay, moving on. The next topic is effects of inflation. Okay. So what is the impact of inflation on fixed income earners? Does inflation have a positive effect on them? Does it not affect them? Does it have a negative effect on them? Negative? Sure, there is no effect. That's definitely negative. Monthly income earners don't get affected. Why? Does it every month? It doesn't. So it doesn't get changed so that is the whole idea. Fixed income earners, be it daily wage workers or monthly salary earners, generally your salary is fixed on a yearly basis. They hire you saying for this year, this is what is going to be your pay. Only at the end of the year, there would be probably a revision and there would be a rise in your pay. So fixed income earners are negatively affected. Even in government service, once in 6 months, there is a component called as dearness allowance. This dearness allowance is revised into correspond to the inflation. But even then, there is no guarantee that it will have a positive impact on them. At best, the negative impact can be reduced to some extent. That is all. Okay. But fixed income earners, when we say their income is fixed, it automatically means that their income is fixed, but the prices are rising, so their expenditure also increases. So they are negatively affected. Who are fixed income earners? Your salaried people, your daily wage laborers. Now this is an interesting point. Now some of you may think that daily wage laborers are actually not fixed income earners. They are flexible income earners. Okay, because there is a second category called as flexible income earners. Can you give me an example of daily wage earners? Who in your mind is a daily wage labor? Construction worker. Any other answer? Give me an example. Companies on a temporary basis, they are fair enough. Small construction work, okay. Agricultural land workers, cottage industries. Drivers, okay, drivers whom we use in our household to drive our cars, right? On and off those. Okay, fine, fair enough. I'm just wondering, okay, so can we say that your auto drivers, can we call them as daily wage earners? The ones who sell fruits and vegetables on cart, can we call them as daily wage earners? You said no.
The income is not fixed.
So is the income fixed for construction workers? So the key difference between say vendors like vegetable vendors, fruit vendors, or even auto drivers and all those people versus a daily wage laborer, there is a key difference. The key difference is that these people We think they have a flexible income. They seem like flexible income people because we understand salary from a monthly concept. Okay, if we break down our salary into a daily concept, we are also daily wage earners. They are also daily wage earners. But for them, the greater harm for them is if they get work for a day, they'll get a wage. If they don't get work, they don't have a wage for that particular day. But their wage doesn't change. If their daily wage is 500, if they have a job, they'll get 500 rupees. If they don't have a job, they don't get 500 rupees. Just because there is inflation, they cannot go and say, today there is inflation, I'll work only for 600. I say tomorrow there is no inflation, I'm ready to work for 450. That doesn't happen. Their daily wage is fixed. That is daily wage earners. Whereas if you take a look at auto, the people who drive their own autos, not driving auto for someone else. Because if you are driving auto for someone else, you might actually be getting a salary. A daily wage or monthly salary is what you might get. If you are driving your own auto, you are driving your own cab, you are selling fruits, vegetables, according to the price levels in the market, you can adjust your prices. Fruit vendors increase the price of fruits if there is inflation. Vegetables, they increase the price if there is inflation. Auto guys say petrol prices have increased, I am going to charge you more for the transportation. So they are not fixed income earners. They can adjust their income or they can adjust their earnings according to the inflation. They are flexible income earners, right? They are small businesses. They are not wage earners. Wage means their income is not directly derived from the work that they do. They do work and they get their income from someone else for whom they are working. That is the difference is there. You need to understand it. In addition to this, there are also pensioners. Pensioners also fall in this category. Okay, thank you for your answers, people online. Anyway, who are flexible income earners? The ones that we just said, small vendors, small or large vendors, small businesses. Now I'm specifically writing small businesses separately and large businesses differently. Because see, in the case of small vendors or small businesses, we can say inflation may not negatively harm them, may not harm them negatively. Okay, but in the case of large businesses, inflation affects them positively. Why do I say so? Because we just discussed in the beginning of this class and in a previous class, the very reason why the government is creating inflation is in order to benefit these business people. So they can produce at the old price and sell at a higher price. So it affects them positively. With these entities, you can say even if there is no positive effect, they are not negatively affected. They can counter, they can manage the inflation situation. So overall, you can classify them as positive effect. Okay, freelancers is a question. I don't know the name of the person who's asking. Freelancers would come under daily wage laborer, would come under that category. If they do work, they get a salary. But how much they get is not dependent on inflation. So they are still going to get the same salary, whether they get it on a daily basis or whether they have a contract or not, doesn't matter. They'll be treated as daily wage laborers. Okay, so the moment you say freelancer, think of it as a freelancer. If I am a freelancer, I am offering my work to someone else. Okay, so I am not, the output of my work is not something that I'm going to directly go and sell. Let's say I am a painter, I am not going to paint and go and sell the painting somewhere. I am a freelancer who has been hired by someone else to do the painting work, which means my output is not to them. I am being contracted by them. That is what is. The moment it becomes a contract, there is a wage that is associated with respect to it. If I am not doing that, then I am not a freelancer. Then I am a business person. I am doing my own painting and I am selling it in the market. I am a seller also. Then I become a small vendor. Okay. It depends on whether I am directly selling what I have to give, or I am working for someone else who does the sale for me. So if I am directly selling, I am a business person. If I am working for someone else, I am an income earner. Okay, so those are the very direct and straightforward things. Now comes the slightly more complex concept. I'm going to give you a couple of things and you tell me whether inflation affects positively or negatively. Bondholder, does inflation affect a bondholder positively or negatively? This involves a little bit of thinking. So immediately Helen says negative. Not just Helen, Niral says negative, Chandramohan says negative, Padmini says negative, Vimal says does not impact, and Ramesh and Ashwin say positive. So no impact is one answer that I'm getting, only 3 possible answers, and 2 people saying positive. So 2 people, how many people are saying, okay, 4 people have said positive, 5 people have said positive, 1, 2, 3, 4, 5, 6, 7, 8 people. 8 people have answered negative. Okay, let me get here. Yeah. Huh? No impact. Huh? Okay. Positive impact. Okay. No impact. Huh? Not able to hear you properly. No impact. Okay. One more person. Not sure. I'm waiting for someone to give me that answer that you don't know. How is it that you know the answer all the time? Okay, I don't know. That's also, I'm waiting for someone to give me that answer. Good. There is no compulsion for you to know the answer to this. It's absolutely okay to not know the answer. So, thank you for that answer. Now, can I ask the people who answered this question, how you arrived at the answer? What is the logic behind your answering? A very good thought process. Very good. First of all, tell me who is a bondholder? Can we give some other name for a bondholder? Is that an investment? Saving? Is there any other name? The one who saves, you could say the one who saves, the one who invests. That's the term that you used. Can we also say this is a person who's a lender? When you say save, when you save in a bank, what are you essentially doing? You are lending them your money. Similarly, when you say bond, you are buying government security, let's say that's a bond. You are giving a loan to the government. You are saving your money. You could save your money in your household also. That is also saving. But you are giving a loan to someone else. Okay. So you are giving a loan. So bondholder is nothing but a lender. The one who, or a creditor, the one who is giving a loan to someone else, that is a bondholder. Good. This level of understanding, having this level of understanding is very, very good. Okay. Creditor. Oh, actually someone has answered that. Meenakshi has answered that. Very good. Okay. So we have a lender. So lender lends, let's say 100 rupees to someone else, in return for which the person is getting a bond. So this lender is A, B is a borrower. Borrower, A is a lender. Okay. What's your name? Ashwant. H. A. Ashwant. Okay, you are Ashwant. So Ashwant says that when the lending happens, it is based on an expectation of what would be the inflation in future. Okay. So let us get this understanding very clear. When we deposit money in a bank, in a normal savings deposit, why is it that they are giving us interest on it? For us to be able to deal with inflation. Okay. So if you look at it in India, the target level of inflation I said is 4%. In a bank, in the current scenario, if you deposit money in a savings deposit where you go and tell them, I can withdraw my money at any time. I am not guaranteeing that the money is going to be there. Even then they'll give you 3.5 around 3 to 4% they are giving you, which means it is helping you deal with inflation. If you put your money in a bank, even in a savings account, it will ensure that 1 year passes, 2 year passes, your money grows in accordance to inflation. You may not gain anything out of it, but at least you are not losing value for that money. So that is what it ensures. So your entire lending will also be on that scenario. Let's say we are expecting an inflation of 4%, and we are giving this loan to them thinking that, okay, I want 8% returns from you, or 8% from you. Okay. If the inflation happens to be 4%, then they are not affected. Then there is no impact on them. Okay, but when you face a question in the UPSC exam, what is the impact of inflation on a bondholder? The question needs to be interpreted as, what is the impact of inflation more than an expected level? That is how you have to interpret. If you interpret it as normal level of inflation, the answer is there is no impact, because they would have expected a certain level of inflation, and that is how they would have decided the rates. You have to understand the question as, what if there is more inflation than expected? If instead of 4%, there is an inflation of 6%, or there is an inflation of 10%. In any of those cases, the bondholder loses money or is affected negatively. They are expecting a return of additional 4%. If it's 6% is the inflation, their return is reduced to only 2%. If it's 10% inflation, they are in fact getting back less money than what they had given in terms of what it can buy, in terms of real returns. You know, real versus nominal concept. We discussed it in a previous class, right? Real versus nominal. In the last class, we discussed that in the beginning, right? Real versus nominal. So in terms of real return, their returns are lesser. Okay. Now, let's consider this. So A gives a loan to B for, so lender of rupees 100. B is going to give back this to A. Okay, B is going to give back to this to A at 10% return. So rupees 110 will be given back. Okay. Assume that inflation is 20% during this year. Assume that inflation is 20% during this 1 year. This is a 1 year duration. Now, how do we know how the lender is affected? When lender initially with A, let us say A with 100 rupees, A was able to buy 5 mangoes, let's say. Okay, 5 mangoes. Or let's say 10 mangoes, that will give us a better number. 10 mangoes, which means 10 rupee per mango. 10 mangoes I was able to buy. Now inflation has happened. 20% inflation means what? The 10 mangoes which was costing 100 rupees last year is going to cost 120 rupees this year. So with 110 rupees, he is not able to buy 10 mangoes anymore. He is able to buy only lesser number. So this is 12 rupees per mango, which means 9 would be 9 into 12 is how much? 8 into 12 is 96. He is able to buy only 8 mangoes with some money left over. Okay, so even with an increased money, not 8, so this will be 96, 104, maybe 9 mangoes is able to buy, but less number of mangoes is able to buy with that same money. You can take any example, pen or pencil or whatever it is. Now look at the situation of B as well. Okay, B borrowed 100 rupees. As of 1 year later, 100 rupees is equal to 120 rupees in this period, because inflation has happened. We also defined inflation as decrease in the value of money. Okay, so 120 rupees today is what is equal to 100 rupees in the past. Okay, but he borrows 100 rupees and is giving back less than the equivalent of that. He needs to give back 120 rupees to claim that whatever borrowed money in terms of real money I have given back, that he is giving back only lesser than that. A has given 100 rupees. If he gets back 120, he says, okay, at least I didn't lose money. I got back whatever I gave, but he is getting lesser money than he gave. And B is gaining some money. By giving back only 110, B is gaining. If B just takes this money and puts it in a bank, where the bank is saying, I'm giving you inflation linked returns, then B will get back 120, and out of this only 10 rupees, 110 they are giving back, B will gain out of it. So the general rule of learning is that inflation negatively impacts bondholders. Bondholders are the one lending money, or in other words, inflation negatively impacts lenders, positively impacts borrowers. Inflation positively impacts borrowers. So you can in UPSC exam, if UPSC wants to complicate things, they may use words like bondholders. To simplify, they may even ask lenders and borrowers. So what is the impact number 3 on lenders negatively impacted. Number 4, borrowers positively impacted. Now, if you have interacted with the bank, for example, if you have lent money to the bank or you have borrowed money from the bank, you'd notice often that when you deposit money in FD, fixed deposits, the bank tends to offer you, in general, the bank tends to offer you a fixed rate, not a flexible rate. There are two types of rates which bank offer, a fixed interest rate or a flexible interest rate. Okay, the bank generally tends to offer you a fixed interest rate on your FD, where the interest rate is fixed. Whereas if you are trying to borrow money from a bank, generally the bank offers you only flexible interest rate loans, where they say according to market scenario, we'll adjust the interest rates. Why? When the bank is taking money from you, they are in a borrower position. If there is inflation, they'll be positively affected. They'll be borrowing money from you, they'll be giving you back less than what they should ideally have. So which is why when they take money from you, they always prefer fixed interest rate, FD, fixed rate. That is what they would prefer. Whereas when they are lending money, they are at risk of inflation. If they give a fixed interest rate loan, if inflation happens, they may be negatively affected, which is why when they give out loans, business loans or personal loans or education loans, they tend to make it flexible in order to adjust for inflation. They'll say, we'll keep the interest rate flexible to inflation. If there is inflation, every 3 months we'll look at inflation, and according to inflation, we'll vary the interest rates of your loans. So that is what you will observe with respect to the banking system. They tend to give out loans at flexible rates because when they give out their lender position, they may be negatively affected. When they take money from you, they are in a position to gain. So they tend to push fixed interest rate deposits. We can ask for flexible. If the bank offers us, good for us. But there is a downside to that as well. If there is no inflation and we choose for if there is a deflation, if we choose for a let's say flexible interest rate, then our returns would go down also. That can also happen. Is this clear? You guys clear? Any questions you can think and ask online? If there is any question, you can think and ask. Remember that all of these we are talking about in the short term. What is the impact of inflation in the short term on these people? If you are thinking about long term, everyone it affects negatively. Even businesses, excess inflation affects them negatively because their cost of production itself goes up. So people may not continue buying goods at high prices. In the long term, people will change their consumption patterns according to the prices. So the business which has produced excess, they may not be able to sell the commodities that they produced. Okay. So in the long term, inflation affects everyone negatively, higher inflation than necessary. If it's beyond creeping inflation, if it's beyond walking inflation, let's say, it affects everyone negatively in the long term. But in UPSC exams, the question will almost certainly be about the short term. If they have not mentioned anything, assume short term. Niral, I didn't understand your question, Niral. What do you mean by gas price increase for Ujjwala Yojana gainers? The price of gas increasing, that is, what is inflation? How is the impact? What are you asking? I didn't understand the question. Can you elaborate a little? And then the next question, Prashant, how government deals with inflation in terms of selling, getting back government securities? Prashant, that is what we are going to deal with next heading, how to control inflation. That will be the next heading. That will be the last heading in inflation. So we'll talk about it. Okay, so the reason I say everything is short term in the UPSC exam, we don't talk about long term is because in the long term, no one can know what is the impact that inflation can have. We don't know what could happen. We don't know what is causing inflation in the long term, first of all. So we cannot predict what might happen. The government may take one measure, the one measure may lead to another result. So we do not know. Too many uncertainties are there. Far too many factors come together to cause inflation. So we cannot predict anything in the long term. That is why we will refrain from commenting on long term impacts of inflation. We'll only talk about short term impacts, short term countermeasures. Okay, so coming to the last major heading inside inflation, it is measures to control excess inflation. I'm not writing the word excess because only excess inflation requires controlling, otherwise it is good. See, there are two entities which have the role of controlling inflation in the country. One is the Government of India, one is the Reserve Bank of India. Government of India's measures are called as fiscal measures. Fiscal measures by the Government of India. When we say fiscal, the moment we say that, we refer to the budget. In the budget, what are the measures that the government may take? Now, let's be very specific. The question is how to control inflation, which means that, see, I told you in the last class, when I ended the last class itself, we are not going to study in detail about supply side inflation. Okay, how to control supply side inflation is what the entire general economics is about. All the various schemes that the government has launched over the years, long-term changes to change the structure of the economy. So that is what will change the supply side. We will not be discussing that at all. When I say how to control inflation, I am only talking about how to control demand side inflation. In the UPSC exam also, unless they specifically mention supply side inflation, assume the inflation to be demand side inflation, because only demand side inflation can be controlled in the short run. Supply side inflation is caused by structural issues. To bring about structural changes, it takes multiple years to bring about, or even in the short term, it will take 2 or 3 years of some revolution to take place, like green revolution or white revolution. Only then can it happen. It cannot be brought down instantaneously. Within a matter of a year, if you want to control inflation, only demand side inflation can be controlled that way. So when we say measures to control inflation, we are only talking about demand side. Okay, and demand side inflation, the cause of demand side inflation is assumed to be excess money supply. So when we say measures to control inflation, you can also rewrite it as measures to control money supply in the economy. That is what we are essentially going to do. Measures to control money supply in the economy. We are assuming there is excess money supply. How to reduce that is the question. The government follows something called as a contractionary fiscal policy. Contractionary means there is a contraction in the government's expenditure. The government is going to spend less, or the government is going to take away more money from the hands of the people. So how is contractionary fiscal policy done? Number one, reduce unproductive expenditure. If there is far too much money supply, reduce the money supply by spending less on unproductive activities. Unproductive activities could be in the form of, let's say, administrative expenses that government servants have to travel from one place to another. All those which are unnecessary travels, cut down on that. Government servants may be staying in 5-star hotels, reduce it, bring it to 3-star hotels. Whatever is excess money that is going out of the government's hands, reduce all those. Subsidies which are going unnecessarily to people who might already have money, they might be availing subsidies, reduce that. That is called as the rationalization of subsidies. Rationalization. Only the necessary people should get subsidies, the others don't get subsidies. That is rationalization. So that could be done. Reduce unproductive expenditure. Increase direct collection. So receipts to be increased. I am very specifically saying direct tax collection. Why direct tax collection? Let's say income tax or corporate tax. If the government increases the rate, more money is taken from the hands of the people and comes into the hands of the government. So that is the idea over there. Increase direct tax collection. But why do I say direct tax collection and not simply increase tax collection? Imagine that indirect tax is increased. GST is increased. It might also take away money from the hands of the people. But how does it do it? By increasing the price of products. What are we trying to do? Control inflation. If we increase the GST, it results in the price of the products increasing, it leads to inflation. It might reduce the money supply by creating further inflation. That we don't want that. We want to control the prices of products by directly taking away money from the people. Okay. Increase direct tax collection. Okay. Now, there is also another type of fiscal policy which doesn't make sense for us to discuss now, but you should know. So, other type of fiscal policies, if there is not enough inflation, consider the current scenario where people don't spend much, there is not a lot of business activities happening, there is not a lot of money movement happening. In such scenario, what the government tends to do is, government tends to spend more, government tends to give more money into the hands of the people. They tend to expand their expenditures, they tend to spend more even if it is unproductive in nature. They tend to create opportunities and give employment, they tend to give more subsidies. Okay, so increases even unproductive expenditures or decreases the direct tax collected. All that is what we call as expansionary fiscal policy. When is that adopted? When we are trying to create inflation. Currently, that is what we are trying to do in the economy. We are trying to increase the productive activities because there is not enough happening. How to do that? By supplying more money into the hands of the people, into the hands of the businesses. All that is what will happen. So what we have learned here is contradictory to what is happening currently in the economy. Because currently in the economy, we don't have excess inflation. We have, of course, in the fuel cases, in some cases we have inflation, but overall, if you look at numbers, our inflation is lesser than what we ideally want. Okay, it's on the lower side because demand activity is not picking up. If there is inflation, it is not because of demand, it is because of supply side issues. Okay, when we say 4% is the target inflation, we are talking about demand side inflation. That is what we are talking about. Demand side, there is not enough inflation happening. Okay, so this is in case there is excess inflation, this is what is to be done. Okay. Now, if we are talking about supply side inflation, currently there are, wherever we see inflation, say fuel price inflation or a lot of other inflation that we see, price rise happening, that is all supply side. Okay. How to control supply side inflation? If you want to take measures, you can talk about things like government making the production process easier, government subsidizing the producers, or government spending more on construction of roads because that will bring down the prices of production, government making the licensing policies easier, liberalization, that will help. So all those you can write, but as I said, I am not going into the depth of supply side. If you write that, you will get confused because in supply side you will see that reduce indirect taxes is what you would write in supply side, because then the price of commodities directly comes down, right? So that we will not discuss for now. If a thought had entered your mind about the supply side, you need to know, or if you had thought, but currently we are experiencing price rise in a lot of fields, how does that explain? How does that go with this? Because we are only talking about the demand side inflation. What we are witnessing currently is supply side inflation or structural issues that are there. Yeah. புரியல எப்படி சொல்றீங்க? பாப்புலேஷன் போடுறாங்க, இண்டஸ்ட்ரீஸ்க்கும் அப்படி பாத்தீங்கன்னா ரெண்டுமே ஒரு பேலன்ஸ். ஓகே, உங்க பேர் செந்தில். Okay, so Senthil's question for the wider audiences. So the government is currently not only giving money into the hands of the consumers so that they can go and demand more, they are also giving some sort of subsidization to the producers also to produce more. That's your question, right? Then how does this lead to inflation which is enabling the economy to grow? The answer is simple. The people need to be given money so that they go and buy. In the previous scenario, prior to COVID, when the producers were continuing to produce, it is the consumers who were not buying. You give money to the consumers, that was enough. Because the products were already produced, it's only about the consumers going and buying those things. But in the context of COVID, even the production stopped. So even if you give money into the hands of the consumers, the product should be there in the market, right, for them to go and consume. So government is now in a situation where they have to at the same time work on giving more money into the hands of the people so that they can go and spend, but government also has to ensure that more products are produced so that when the people are going out to buy, the products are available. Imagine people going out to buy a car and then in the store they say, sorry, we don't have a stock of car. They'll change their plan. They might go and do something else with that money, which is why to enable further production, the government is subsidizing them also. Okay, that is the reason for that happening. Questions online. Now gas price is increasing. Is it affect the price of gas cylinders on Ujjwala Yojana cylinder holders? It will affect. If the gas cylinder price is increasing, it will increase for everyone. If the government wants to not government wants those people not to be affected, they might increase the subsidy also. But I don't think the government is going to do that. The government will say we'll still continue giving the old subsidy, they just have to pay 25 rupees extra. So it will not have a bearing on the Ujjwala Yojana, it will just have a normal bearing. The prices increase for everyone, it increases by 25, for them also it increases by 25. Okay? Alright. Soundarya, why did you say 333? Was that an accidental text? You have sent some message. Okay, accidental, that's okay. Can we call the Atmanirbhar scheme as measure to raise inflation? Vimal, rather than calling Atmanirbhar scheme as a measure to raise inflation, see, in an examination, when you write some things like this, don't say Atmanirbhar scheme results in inflation. Because the general perception, you are writing a general answer, the general perception is that inflation is not ideal. So when you talk about Atmanirbhar scheme, you have to write Atmanirbhar scheme was introduced to revive the economy, to increase production, to increase consumption. That is how you have to write. For a person who understands the concept, they'll know that, okay, inflation is what will result in those things. But when you write it as an answer, you have to write it in a generic way that common man can understand. Not an economist can understand, but a common man can understand. Okay. Sometimes your paper, your GS paper, not sometimes, almost all the time, your GS paper will be corrected by people who are not specialists in this field. Okay, they'll just be given a key and they'll say understand this key and correct the answer accordingly. They may not know the intricacies of your answer. If you write it too technical, this is a trap which a lot of economic optional students fall into. When they write GS answers, they get too technical and explain the concepts technically, they end up not getting marks. They end up getting lesser marks than other general students. So with any of the answers, if geography is your optional, your geography GS1 answers should not be very technical. It has to be generic in nature. So write it in a way a common man can understand. How does a common man perceive inflation? You'll have to answer accordingly. I am teaching you this so that you understand the concept, but when you present the concept, you have to present it in a common man language. Okay. So I would suggest you present it as Atmanirbhar helps in increasing consumption and production. How it happens, it is not very necessary to write it there. Ashwin, is it relevant here? Is that question? If not, I'll take it up later. Okay. So these are the fiscal measures. In addition to this, there are also some exceptional kinds of reasons for inflation to take place. Exceptional reasons for increase in money supply. Do you remember the third point? What increases, on what basis does the quantity of money increase? I told you in this chapter called as money. Why is the money increased in an economy? Why is the quantity of money available increased in an economy? Number one, to increase the quantity produced. Number two, to create inflation. Number three, I had told you a reason. What is it? No, not multiplier. That comes later. Three reasons why money supply is increased. Yes, correct. Prashant says answers it correctly. When there is an excess inflow of foreign currency. Remember, I had said that when there is an excess inflow of foreign currency in India, that much currency is not there. But the ones who are bringing the currency, we need to pay them in Indian money. So more currency has to be printed. If the government has taken some policy which is resulting in excess money supply in the economy, it could be in terms of government has relaxed FDI norms, more and more foreign currency is coming in, or foreign investment, not just FDI or FPA or any of the norms, more foreign currency is coming in, or exports have been significantly promoted, more foreign currency is coming in, or very simply government took some measure as a result of which a lot of the money which was earlier in the banks in India have now come into the hands of the people. If any of this happens, now I'll give you an example of the third one I just said. When demonetization happened, when demonetization was done, a lot of the money which was there in the hands of the people came into the banking system. It needed to be converted to new notes. But people were always afraid that because of the current currency crunch, they were withdrawing more money than necessary, so that what if an ATM runs out of cash? This was a realistic problem for everyone. What if ATMs run out of cash? What if there is no money there? How will I survive? So people started withdrawing more money than was necessary in the economy. So there was an unusually high quantity of money available in the hands of the people post demonetization, when remonetization started happening. So that is a government measure which resulted in increased money in the hands of the people. FDI, exports, earnings and all those. These are situations where a government policy is resulting in excess money supply. In such cases, those are exceptional circumstances. Those are not regular circumstances. In such exceptional circumstances, the government of India involves itself in something called as market stabilization scheme. So Prashant, this answers your earlier question as well. You had asked me a question about this earlier. So market stabilization scheme is used by the government. What they do is, through the RBI, they issue new government securities. They issue new government securities and they borrow money from the people. But this money does not go into the hands of the government. The idea here is not for the government to generate money. You remember in public finance when we learnt about government securities, the idea was government has a deficit, which means it has an expenditure, it doesn't have the money to meet that, so it is borrowing money from the people to meet that expenditure. So whatever money it gets, it already has a use for that money. But in this case, the government is not borrowing because it has to spend or because it is falling short of money. The government is borrowing in order to regulate the money supply in the economy. This is normally Reserve Bank of India's role. But here the government is stepping in because it was the government's regulation which resulted in excess money supply. RBI will go to the government and say, we will not be able to manage alone. You will have to step in and do this process. So the government issues new government securities so that money is taken away from the hands of the people, but it will be kept as idle money in the hands of Reserve Bank of India, so that money supply in the economy is reduced. So they issue government securities and suck out liquidity from the economy. You understand what is meant by sucking out liquidity? Taking away the excess money. Liquidity is cash, easily available cash. So that is what we mean by liquidity. Sucking out liquidity means taking away the cash that is there, excess cash in the economy, and keeping it as idle money with Reserve Bank of India. So that is a measure that they do. And gradually over the years, they will bring out this money back into the economy so that there is no sudden influx of excess money. That is what can happen. Any questions on this? Any lack of understanding here? Any question here? Online? Vimal, can we keep that question to the end of the class? I repeat to everyone who's attending the class, when you are asking questions to me, don't just follow the process where you think of a question, okay, let me ask this immediately. When you think of a question, ask yourself, is it relevant to the topic that we are currently discussing? Is it a lack of clarity in what we are discussing? Then you ask me so that I can clarify this. If you are asking me a thread based on what we are discussing, if you are asking me a hypothetical question, or if you are asking me some other related but currently irrelevant topic, note it down somewhere and ask me the question at the end of the class. It will help me answer. I understand your curiosity, but your curiosity questions, if I go to answer all those questions, it will break the flow of our discussion. Okay. So, Vimal, please ask me the question at the end. Ashwin, please ask me the question at the end again. When I say end, maybe another 5 minutes. In another 5 minutes, ask me the question. Okay. It can use it. It can. If there is a deficit and if they want to get the money, it can get that money from Reserve Bank of India. It is the government which is giving it to them and saying you keep it without giving it to me. Next year, if there is a shortfall, if they need the money, they can use the money. So when we say, that is what I said, it will gradually bring it back into the economy. When I said, what I meant is that if there is a need for that money, when we say if there is a need, when should there be money? Whenever there is an equivalent production happening or equivalent value generation that is happening. How did we say how much money should be there? Whatever is the GDP of the economy, in correspondence to that, there should be, after considering the multiplier. So when we say next year, if the government has a deficit, why would the government have a deficit? Because the government is spending on some generally productive activities. So for that, if the government is spending and it doesn't have money, it can take this money. No issues. Okay. So moving on to the second entity who controls inflation. The first entity was the government of India, fiscal measures. The second is what we call as the monetary measures by the Reserve Bank of India. Okay. Monetary measures by the Reserve Bank of India. So first thing that we discuss, they follow, okay, I'll put this as number 2, changing the nomenclature a bit. Was number 1, is number 2. Something called as open market operation. So let me see if I'm visible while there. Was busy kara? Was technician. இதோடுங்க அவரு கொஞ்சம் கேமரா ஆங்கிள் லோவர் பண்ண முடியுமா? உங்க பேர் என்ன? போதும் 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 போதும். உங்க பேர் என்ன? சுரேஷ். Thanks, Suresh. All right. So now when we say open market operation, it is almost exactly the same as market stabilization scheme. Okay. If there is excess money in the economy, the Reserve Bank of India will reissue government securities that are there and take away money from the hands of the people. That is the same process of market stabilization scheme. Okay. But the differences lies in that Reserve Bank of India does not have the authority to issue government securities, because government securities are government's securities. Government of India is the entity which has the right to issue government securities. RBI does not have securities of its own to issue. RBI does not have the right to promise anything. The only promissory note that RBI issues is the currency note, where the RBI governor says, I promise to pay the bearer a sum of. That is the only note that they issue. Other than that, only the government can issue government securities. The RBI cannot issue government securities. So we have to be very clear about that. And you remember from the FRBM Act. From the FRBM Act, we said there should be no monetization of deficit. You remember? One of the points was government should not borrow directly from Reserve Bank of India. What is borrowing directly from Reserve Bank of India? Government should not issue government securities to Reserve Bank of India and borrow money from them. That cannot happen. Government, when it is borrowing money, it has to issue government securities to the public, and from that it can make money. Why do we say so? Because if it is issuing government securities to RBI, RBI will be forced to print currency, new currency, and give the loan to the government. Whereas if government is issuing to the public, it is only taking in already existing money from the economy. So these are the reasons why we said no monetization of deficit. Okay. Then how is, I said, on behalf of the government, RBI is issuing government securities in market stabilization scheme. The government says, I am not issuing security to you. Since you are my banker, I am giving you the security. You issue it on my behalf, you get the money, and in my behalf, you keep the money. On my behalf, you keep the money. So RBI is only a facilitator there. They are only providing banking facility. They are not issuing, they are not buying the securities in market stabilization scheme. But in open market operation, one of the most important ways in which RBI regulates the money supply in the economy is the government securities that have already been issued by the government to the public. The RBI has every right to go and buy it from the public. Nothing stops RBI from doing it. Government of India issues government securities in the market to the public, to the businesses, to the financial institutions, banks, wherever it is. After it has been issued, the Reserve Bank of India has complete freedom to go and buy it from them. They can say, I'll give you money, whatever is mentioned on that, you give me the government security. Which means RBI is now holding government security of its own, but it did not buy it directly from the government of India. It bought it indirectly. It bought it from the people. Second hand, it can buy government securities. It cannot buy it first hand. What difference does it make? Because when it is trying to buy second hand, it doesn't have to print new money. It can use existing money and buy. Only if it has money, it will buy. Otherwise, it will not buy. Okay, there are also, once we understand banking, as we go ahead with this topic, you will understand that there are some criteria which RBI sets to the banks, whereby it says some part of the reserve held by the banks has to be in the form of government securities. Compulsorily, banks have to hold government securities. There are rules which say that. Then later we'll also learn about something called as repo rate and reverse repo rate, repo transactions. Okay, I'll tell you about that when we get there. These repo transactions are also based on government securities. Banks have to mortgage government securities to Reserve Bank of India if the RBI has to give a loan to the banks. So all these are means in which the Reserve Bank of India accumulates government securities over time. So there are a lot of government securities in the market which the market got directly from the government. There are also a lot of government securities in the hands of Reserve Bank of India which the RBI again got from the market, not from the government but from the market. Okay, through its market control, it has a lot of government securities. Now, with the various government securities that are available in the economy, in the hands of the people, and the various government securities that is available in the hands of Reserve Bank of India, RBI can control money supply. How? When it feels that there is excess money supply in the economy, Reserve Bank of India will use the second-hand G-Secs that it has. It will reissue those government securities to the public and say, I'm reissuing it, you give me the money. So, because the RBI holds those, RBI owns those government securities. They are not issuing it. It is still issued by the government of India. They are reissuing existing government securities that was in their ownership. They reissue it, they take the money and they keep it idle. They can do that. The opposite, that is called as open market operation. They'll go to the open market and say, I am willing to sell government securities. Anyone who's interested can come and buy. Or they can do the opposite also. That is also open market operation, where they say, I don't have enough government securities. I feel there is a shortage of money supply in the economy. I will give you money if you come and give me government securities, if you sell your government securities to me. So people who are holding government securities, they'll feel, okay, this is an attractive offer. I need instant money. So they'll take money from the Reserve Bank of India and give government securities. That will increase the money supply. So here the question is how to control inflation. In open market operation, RBI reissues government securities and takes away, sucks out liquidity from the economy. That is one kind of open market operation through which it regulates money supply in the economy. Karthik, that is exactly what I mean. I'm intentionally avoiding words like secondary market. See, G-Secs, any security issued by the government of India, any bond issued by the government of India can be classified as G-Sec. Okay, if you are generally going by the word, what is a government security, then treasury bills are also government securities. Your dated securities, 1 year, 2 year, 10 year, 20 year securities are also government securities. But specifically, if you are classifying it by name as G-Sec and T-bill, only securities of longer than 1 year tenure are classified as G-Sec, less than 1 year tenure are called as T-bills, specifically name wise. But in generally, what are the government's securities? If you are asking that, then T-bills are also government's securities issued by the government. G-Sec என்ற பேர்ல தெரியப்படுறது வரும் long term மட்டும்தான், 1 year and above. Okay. Karthik, sovereign gold bonds are not issued by RBI, they are issued by the banks. So that doesn't come under open market operation. Individually, banks can offer sovereign gold bonds, especially SBI, I think, is in charge of doing that. First week of every quarter, I think they do it, sovereign gold bonds. So that doesn't come inside this. Okay, so there is a terminology also. I'm just introducing to you now. It is not very relevant for you to understand it right now. Just introducing in case you understand it. Okay, when shares and all these securities are issued for the first time by anyone, government is issuing their shares for the first time, or government is issuing their securities for the first time, or a company is issuing their shares for the first time. that issuance of share and buying of share, issuance of bond and buying of bond, all that happens, that market is called, the place of interaction is what is called as a primary market, because it is happening for the first time. Okay, when it is reissue or resale, repurchase, any of this is happening, it is a second hand sale. So that is called a secondary market. Now why do I say this? Because in a lot of places you would find that the FRBM Act prevented the RBI from buying government securities in the primary market. But RBI can buy government securities from the secondary market. This is something that you will see. It essentially means RBI cannot buy GSEC directly from the government. They can buy it from the public. That is what it means. So I'm introducing you to the words primary and secondary market. Primary market is where the issuer is the owner, original owner of that bond. Issuer and owner are the same. Whereas in the secondary market, the issuer is a temporary owner. Second-hand sale is what has happened. So from a share market concept, you know about BSE, NSE and all those you might have come across, like Bombay Stock Exchange, stock exchanges. Stock exchanges are where one person exchanges their stock with another. They are not places where stocks are issued. They are places where stocks are exchanged, which means all of them are secondary market. They are not primary. Anyway, we'll discuss this primary, secondary and all those in financial markets class. That will be the last core economics class that we have. I will explain all these concepts to you. Okay. All right. So it's 4:37. We'll take a break. We'll come back at 5:5. We'll come back and then we'll finish rest of inflation, the remaining measures to control inflation. Okay, half an hour break. Thank you. People online, you can disconnect and come back, reconnect later. A couple of people had questions. If you want, we can wait and discuss those. Vimal and Ashwin. Let me know if you want the answer now. So Vimal is here. Ashwin is also here, I think. Please respond if I can answer now or... Okay, Vimal, to answer your question, can you tell us the impact of digitalization on inflation? See, the direct impact of digitalization you can talk about in terms of money multiplier, which with digitalization, the value of money multiplier can increase. More money remains with the bank itself, less money is in the hands of the people. With more money in the banking system, more is likely to be the multiplication. If the Reserve Bank of India fails to take this increased multiplication into account, it could lead to more money available than necessary, because money is multiplying to a greater extent. That is a possible impact, but RBI will consider that. That is one line of impact. The second line is with greater digitalization, because people are not using cash, a lot of times people don't feel that the money is leaving them when they spend. And easy accessibility of goods and services makes people demand more and more. That could lead to inflation in the economy. So digitalization would result in a lot of online transactions, resulting in a higher demand, overall demand increase, and thereby can cause inflation. Okay. You guys can actually walk out, no issues. I'm talking. You don't have to wait here just because I'm talking. Okay. If you want a break, you can take a break. Class is over officially. I'm just answering a few doubts. Okay. So that I have answered Vimal. And to answer Ashwin's question is, in bullet train project, construction infra, every work is done by Japan. How will India gain? See, India's gain is in terms of the fact that number one, bullet train project itself comes into India. That is the biggest gain, that a bullet train technology is there. Second advantage is that if you have first of all, Indian companies don't have the know-how or the expertise to do bullet train project. So we need some foreigner to come and some foreign company which has expertise to come and do it for us. Okay. So otherwise, we might be able to develop technology, but it will take many years for some company to do research and development and come up with the bullet train concept. So we want it faster. We are asking a Japanese company to do. Eventually, Indian companies will also learn from the process, and maybe the next bullet train project will be an Indian company. And more than that, like I told you in the public finance class, the entire project is funded by the funded by the Japanese Infrastructure Cooperation Agency, I think JICA. So they are the ones who are funding it for now, where the loans are extremely favorable to India. So in every sense, India is benefiting from that project. Yes, it does not generate business in India, but definitely it generates employment, at least at the local level, because Indian employees may be employed in the whole process, production process. So it will be helpful. Okay, I hope that has answered your question. Yes, Japan is offering very low interest, correct? Sir, does RBI reissuing GSEC also follow at least 1 year maturity period? RBI cannot alter the maturity period in the securities. Please note that. RBI cannot make any alteration to the maturity period of securities because the maturity period, the interest, everything is decided by the government of India. RBI cannot change that at all. The only thing RBI can change is what is the price at which the security is issued. That is the only thing that they can change. Okay. Whether Operation Twist used by RBI is also an OMO measure. Yes, Helen, it is an open market operation measure, but I'll be refraining from talking about Operation Twist right now because Operation Twist involves a slightly more complicated level of understanding, which I explain now. If I explain now, it will not be understandable for the general audience. So I'm refraining from doing that for the time being. After I teach all the basics, then you can go back and understand Twist. Slightly easier. Okay. All right, I don't see any other questions, so I'll disconnect and we'll connect at 5:05. Thank you. Niral, I have disconnected. Did you have a question? I see that you're still connected. Niral? Niral, are you able to hear me? I'm not connected, so I'll not be able to see messages if you send any. Mute இருக்கனா சுரேஷ் அவர் மியூட்ல வச்சிருக்காரா சரி ஓகே Shall we continue? Others, you have contact with them? No. We'll continue anyway. Guys online, shall I continue? Helen's there. What about the others? Okay, Soundarya is on video. Prashant is on video. Alright. Messages from Akhilesh, Karthik, GV, Nishchit, Asha. Alright. Okay, so we just discussed what is open market operation. We said that it is very similar to market stabilization scheme. The difference being that in market stabilization scheme, it's issue of government's new securities. Here it is reissue of securities. So that is what happens in open market operation. Okay. In the case of measures to control inflation, it is issue of reissue of government securities. In the case of increasing the money supply, they will buy government securities from the market and give money. So it works both ways. I am only talking about controlling money supply. Okay. So that is one measure, open market operations. Okay. Then we have another measure, feature called as variable reserve ratio, which can be used by the Reserve Bank of India. Variable reserve ratio. Now, what is variable reserve ratio? The rules of Reserve Bank of India under the RBI Act and as well as the Banking Regulations Act and all those, they mandate that every bank maintain a certain proportion of the deposit that comes into the banking system in the form of reserve. For example, if you and I, we were to go to a bank and deposit 100 rupees, the rules of Reserve Bank of India state that a certain proportion of that needs to be maintained as reserve. It cannot be given out as loan. If you remember from the concept of money multiplication, we said fractional banking. 100 rupees is deposited into the bank, a fraction of that is maintained as reserve, as cash itself, the remaining is given out as loan. So 100% of the money that comes into a banking system cannot be given out as loan. So that percentage which needs to be kept as reserve is what we call as variable reserve ratio. Variable because the RBI can vary it from time to time. So there are two types of variable reserve ratio. One is called as cash reserve ratio. The second is called as statutory liquidity ratio, shortened as CRR and SLR. Both have the same definition, a general definition. Both refer to the percentage of NDTL to be maintained as reserves by banks. Now, what is NDTL? NDTL stands for net demand and time liabilities. Percentage of NDTL to be maintained as reserve by the banks. NDTL stands for net demand and time liabilities. Okay. Now, what are liabilities for a bank? So every financial institution, say like a bank, has two things. One is liability, one is asset. The loan given by a bank is an asset because it has the potential to one, come back and earn money. What is a liability? The deposits that it accepts, because it has to give back the deposits, it also has to pay an interest on top of it. So when we say liabilities, what we mean is deposits into the banking system. So net demand deposits and time deposits is what we mean by net demand and time liabilities. Time means term deposits. There is some time associated. It is not something that can be withdrawn on demand. That is what we mean by time liabilities. So a percentage of the deposits that come into the banking system need to be maintained as reserve. That percentage is what is variable reserve ratio. Both of them have the same definition, general definition. So what is the difference between them? The name itself says cash reserve ratio. So this is the proportion of NDTL, this is the proportion of reserves that has to be maintained only in the form of cash. So you can write it over here. So I'm classifying it as CRR and SLR. So CRR only in the form of cash. Which means this reserve has to be maintained as liquid cash with the RBI. So the banks have to deposit this money, this reserve money, with the Reserve Bank of India. Banks have to deposit it with the Reserve Bank of India. Do you remember in M0 there was a categorization called as bankers deposits with the Reserve Bank of India? There were three things in M0. Monetary aggregates. In the money chapter, you can quickly turn back and check. In monetary aggregates, we said M0 is equal to currency in circulation, which is nothing but currency in the hands of the people, plus currency in the hands of banks, currency in banks. Plus, we said bankers deposits with the Reserve Bank of India, and we said other deposits with the Reserve Bank of India. The bankers deposits with the Reserve Bank of India, one of those deposits is in the form of cash reserve ratio. Okay. But since this deposit, the intention of this deposit is to protect this money, not to save or not to give out a loan, because RBI is also going to keep this money idle. It is to protect this money. The RBI does not give any interest payment on this. So no interest earnings for the banks. No interest earnings for banks. Okay, so cash reserve ratio is a proportion of the deposits that come into the banking system, which has to be maintained as a reserve in the form of cash with the Reserve Bank of India with no interest that the bank is going to get out of it. That's cash reserve ratio. I'll give you the significance of this last line again. Once I tell you what is SLR, I'll tell you, you'll understand why it is relevant for me to say this. So SLR can be in the form of cash, but if it's in the form of cash, once again, they'll not earn. So it can be maintained in the, generally it is maintained in the form of government securities. So when I say government securities here, I'm not specifically mentioning G-Secs. I shortened this as G-Secs. You can write it as securities in the form of government securities, because I include T-bills as well here. Gold and other accepted securities. From time to time, RBI may say, in addition to government securities, we may also allow other securities. Say some really well established companies' securities, a top public sector enterprise or even a private enterprise which has, which is extremely highly rated when it comes to repaying loans. So highly reputed companies, so top rated companies, their securities may also be allowed. Okay, so the idea here is that the bank has to maintain a reserve, okay, but it should not be a penalty for a bank, because if they keep money as idle money, and they are not going to get any no interest out of it, then the money is waste. They are actually losing value on that money, because if the money stays for 1 year and they are not earning any interest, it is like keeping money idle at home. Because of inflation, the value of that money will be lost. So CRR actually leads to a loss to the banks because the money is kept idle. To prevent that from happening, they are saying you can deposit in the safest forms, and the safest forms are government securities. So the next safest is some really highly reputed companies may also be allowed, may be allowed. Sometimes RBI says not allowed, only government securities. Sometimes they may bring in rules say it is allowed. So it depends on RBI's rules from time to time. And gold also is reasonably safe, but there is always a risk of value going down with respect to gold also. So generally, banks prefer to hold it in the form of government securities. Okay. So which means that the reserve need not be given to anyone else, the bank maintains with itself. Although we say with itself, you have to realize that in this case the money is given to Reserve Bank of India. In this case also the money is given to someone. Who's the money given to? Either the money is given as a loan to the government, or the money is spent on buying gold, or to some other highly reputed company. But it is treated that since there is a security got out of it, that security is what is the reserve. We treat SLR to be something that is maintained by the bank with itself. That is how we'll write it. So SLR is maintained by the bank with itself is how you have to write if there are questions asked on it. CRR is maintained with the Reserve Bank of India. SLR is maintained with the bank itself. That is what we would say. Because they can maintain this as cash also. There is nothing which stops them from doing it. So if they maintain it as cash, it will be with themselves. But the problem is it won't earn them anything. So they wouldn't generally do that. They would keep it as government securities. Okay. So what does this mean? Because it is in the form of securities, it has the potential to earn. Now, yeah, sorry. Which one? Securities. It has to buy directly from the government. When the government issues it, it has to get it from there, or else through various means like what we learn about repo and all those. Then see, RBI does not have the authority to issue government securities of its own. For the first time, it cannot issue. Only the government can issue. After that, resale of securities RBI can do, but RBI will not do that, because when RBI does that, it will change the money supply in the economy. Okay, so unless there is a reason, RBI would not, just for the reason of providing securities for SLR, RBI would never do that. But from time to time, RBI will say, for certain reasons, we are issuing securities. At that time, these banks have to go and buy it from the Reserve Bank of India. Or when a government is issuing it for the first time, then these banks can go and get it from there. Okay. Okay. Now, why did I write the last point? Now, let us say there is an overall variable reserve ratio of around 20%. Assume it to be 20%, which means 100 rupees comes into the bank. Only 80% can be given out as loan. 20% needs to be maintained as reserve. Okay. Which one would be higher, CRR or SLR? What would RBI mandate to be higher? What do you think? Just tell me what you feel about it. Which one do you think would be higher logically? SLR would be. Why? It has a potential to earn. It acts as a reserve, but at the same time, it doesn't cause a loss to the bank. Okay. RBI wants there to be reserve, but RBI wants the banks to suffer as less as possible. CRR is a sort of suffering for the bank because they are not earning anything out of it, which is why I say no interest earnings. Why do I say? Because when you look at the rates in the economy, there is currently I think 22.5% overall, of which CRR is only 4%. Currently I think 3%. In the context of COVID, they had reduced it to 3%, and SLR is 18.5, 18 or 18.5%. So 4 plus 18.5, 22.5. Currently 21.5 because of this. But RBI is already in the has started the procedure to bring it back to the level of 4. Okay, so in the long run, it is going to be 4. So 4 and 18.5. I think this they are planning to reduce it to 18 in the long run. So it will be around 22%. So for you to remember which one is greater, is it CRR or is it SLR which is greater? Always remember CRR doesn't fetch any revenue for the banks. So it is as minimal as possible. Only 4% here, whereas 18%, around 18% is over here. Okay, if you know that this doesn't earn anything, it is easier for you to remember which is which. Thank you so much for your answers. Saravanan is asking, what is meant by potential to earn? Potential to earn means because it is in the form of government securities, they are going to get some interest out of it. But why do I say potential to earn? Because although, see, with government securities, we say 100%, zero risk. If they choose to invest in, let's say, some other private securities or in the form of gold, there is a small element of risk. That is why we say it has a potential to earn. Whether it realize it in reality also they earn or not depends on a lot of factors. Okay, so that is why I always write about any sort of an asset. We can call it as an asset if it has a potential to earn, whether it actually earns or not. When we get to banking chapter, we learn about this in even greater detail, where you give a loan to someone. It is an asset because you are expecting that the money will come and also the interest will come out of it. But there is also a practical possibility that the person who borrowed the money loses the money and is not able to repay. We will not call it as a liability then. We will call it as an asset which is not performing its role. It had the potential to give us money, earn us money, but it is not fulfilling its potential. It will become a non-performing asset rather than a liability. So that is why I keep using the word potential over here. No, by its definition, it is supposed to earn. It may or may not. There is a mandate. So the question is there a mandate that banks must keep only in CRR? No, there is a mandate which says that banks have to maintain CRR as well as SLR. Both of these are compulsory. Every bank, if it's a scheduled bank, what is a scheduled bank? Bank which is under the Reserve Bank of India, under the schedules of Reserve Bank of India. If it is a scheduled bank, then there is a mandate that they have to maintain 4% of their NDTL as CRR and 18% of their NDTL as SLR. These numbers could vary from time to time. I'm just taking an example. In my class, I'd never give you any numbers with certainty because these numbers will change over a period of time. If you write it in your main notes, you will believe all the time that you study that it is the final number. So numbers are variable. Concepts are not. At least in the short run, concepts don't change. Okay. But in the long run, even concepts in economics can change. I'll give you examples of that. Okay. CRR, SLR. Now, have you understood? Can I move on to the next one? Variable reserve ratios understood? Online? But bank is keeping with itself for reserve. How bank get interest or return? Saravanan, so that is the point. When I say bank is keeping with itself, it is just for the sake of saying that we say that bank keeps with itself. But bank is actually giving the money. How can it get government securities? By giving that money to the government. They'll get government securities, or whoever is holding a government security, by giving it to them, they'll get the money, right? So the money is actually not in their hand, but the security is in their hand. That is why we say with itself. Okay, it is not maintained as cash. It is maintained in the predominantly. It is maintained in the form of government securities. Means what? It is giving the money to someone else and getting government security. So it has the potential to earn from that government security. Because it is maintaining the security with itself, we say the reserve is maintained with itself, and it also has the choice of keeping it as either security or gold or as other securities. Okay, hope that is clear. Okay, if you feel that the entire concept is clear, now tell me, based on what I have taught you already, tell me how does this help in controlling the money supply in the economy?
RBI will increase the rate.
Correct.
The bank cannot lend money.
Exactly. So that is the key point. See, the intention of teaching you this is not to teach you about CRR or SLR. The intention is to understand how RBI may use CRR or SLR to control liquidity. I just now told you that CRR, which was consistently 4% for a long period of time, during the pandemic period was reduced to 3%. Why? Because if banks only have to maintain 3% CRR, the remaining 1% which was earlier kept as reserve now is available for the bank as liquidity, as liquid cash, so that they can give out more and more loans. Increases the amount of money available in the hands of the banks if the CRR is reduced or if SLR is reduced. On the other hand, if CRR or SLR is raised, contrary to what happened in this case, it will reduce the amount of money in the hands of banks to give out loans. More money might have to be given to the RBI as reserve, or more money has to be given compulsorily to the government to get government securities. Either way, the amount of money available in the hands of banks to give out loans reduces, thereby controlling the money supply in the economy. Okay, so that is how it works. Both CRR as well as SLR works that way. Yeah. Government cannot ask anything because banks are regulated not by the government but by the Reserve Bank of India. However, the banks are always in need of government securities. You will see in the next topic also, for borrowing money from RBI or to maintain SLR, for whatever reason, banks are always in need of government securities. So when government wants to borrow money from the public, the government will just go and say, we are going to issue government securities. The banks will queue up, and that is how the auctions and all those happen. You remember I said issued at discount, redeemed at par. there is an auction system that takes place with T-bills and G-Secs and all those. You might wonder, who is it that who's going to come and bid? Because it is such a mandatory part of running a bank to maintain these government securities, they'll start bidding. So government will not issue government securities saying SLR should increase. Government will issue government securities because RBI is mandating some SLR or some other form of government securities. The banks will definitely come and buy. That's all. They can. For example, if you have an account with some bank, the bank may send you SMSs saying that we see that some money is lying idle in your account. If you are interested, you can invest this money in government securities or some other corporate securities or some of those things, which means that these banks can also facilitate you to buy government securities. And when if you remember from the public finance chapter, I had told you that government offers government securities to the public at large, but T-bills are offered only to financial institutions. You remember me saying that there is a distinction: short-term business motive only for financial institutions, long-term open to all. But even then, when these government securities are issued, they are issued only to, say, banks or financial institutions. The difference is these government securities can then be issued by the banks to other entities, like their customers. So as a customer, we can walk into our bank and say, I am interested in investing my money in government securities. Please let me know if you can help me access those. Or we might have to go to some investment company or mutual fund company, and they might also have bought some government securities and we can invest in them. Banks, if they want, can issue the government securities to the people. It can be done. What percentage? Definitely it has to, which means that if it has only 18% of its NDTL in the form of securities, it cannot issue any government securities. Only excess. If they have 20 or 25%, if they have securities beyond that 18% category, only that can be used for issuing. Okay. So at any given point of time, they have to maintain that SLR. There is actually one exception where they can use that SLR for some transaction. I'll tell you about that also. But conventionally, they cannot use it. That SLR has to be maintained as security with themselves. Okay. Now coming to what is the number here? Number 2, right? Yeah. So 2 done. Now third is what we call as liquidity adjustment facility. Now, before I explain liquidity adjustment facility to you, okay, before I tell you this, I'll have to ask you a question about the variable reserve ratio, but a couple of questions from online. Okay, correct. Helen's answer is correct. If RBI increases CRR, money left with bank will, okay, correct. Sandra Mohan's answer is correct. So Saravanan question, sir, open market operation also controlled by security, SLR also by security, how it is different in control of money? Saravanan, so if you just think of this, you will be able to answer this question on your own. If you understand both the concepts and think of it, you will be able to answer on your own. But to help you with that process, I'll explain it just quickly. Okay. In open market operation, the Reserve Bank of India directly interacts with whoever has the government securities. Okay. Directly interacts with those people and say, I am going to take away the government security or I am going to issue government securities. That is how it does. In the second case, in statutory liquidity ratio, the Reserve Bank of India only says to the banks, and this is only to the banks, they say whatever the deposit that comes into your banking system, 18% of that has to be in the form of SLR. They are not even mandating government securities. They say it has to be in the form of SLR. And SLR can be in the form of cash, in the form of government security or gold or other accepted securities, anything. So it is up to the bank now, depends on how much money comes into the banking system, because SLR is not the same for everyone. The percentage is same, But what value of SLR that they maintain depends on how much money comes into their banking system. So it is very, very different. In the first case, open market operation, the RBI itself is issuing or buying government securities. In the second case, the RBI is not involved in this process at all. RBI is telling the banks, wherever you get from, I don't care, you go and buy government securities and keep it with you as a security. So this actually brings us to another question. Can we say that CRR SLR, the primary role of CRR SLR is to control liquidity in the economy? Can we say so? Waiting for people online to answer. Can we say that the primary role of CRR SLR is to control liquidity in the economy? So a lot of people here answering yes. Is there any change in answer here? Let me know. Chandramohan is saying no. Radhakrishnan also saying no. What was your key word? Primary. Yeah. So I asked a very specific question. Is the primary role? Primary role means what? The most important role. The reason why such a concept exists. Is it to control money supply or is it to protect the depositors' money? The primary role of CRR SLR is not to control liquidity in the economy. It is to protect the depositors' money. Because it is a mechanism which is available, the RBI may use it to control money supply also. It is an additional function. It is not the primary function of variable reserve ratio. The primary role of variable reserve ratio is to protect the depositors' money. That is why it is called as a reserve. Okay. Additional feature is because it is available there, it can also be used for controlling money supply. So that is Radhakrishnan's point is correct. Niral's point, Niral said no. Chandramohan also said no. It can also be used. Correct, Chandramohan? To protect depositors' money. Very good, very good. Ramesh also answered that. To prevent excess loaning, not illegal, to prevent excess loans given by banks. Okay, how does the government of RBI decide which control measures have to be taken? You will understand. Once I finish discussing all these things, you will have a better understanding of that viewpoint. Okay, now what is the primary means that RBI uses to control money supply in economy? The name itself says liquidity adjustment facility. There is some facility available with the Reserve Bank of India through which it directly controls the money supply available in the economy. Okay, liquidity adjustment facility. Under this, we again have two things. One is called as repo rate. The other is called as reverse repo rate. These are the means by which the Reserve Bank of India directly tries to control money supply in the economy or money supply with the banking system. Repo rate is defined as the rate at which RBI lends to banks. The rate at which RBI gives loans to banks or lends to banks. In mortgage of government or other accepted securities. In mortgage of government or other accepted securities. Government securities or other accepted securities. So it is the rate at which RBI lends to banks in mortgage of government securities or other accepted securities. Which means what? RBI will fix a date and say, on this day, I am willing to lend money to you. If you want money, you can come and get it from me. I am willing to lend money to you, provided you can provide me some sort of a security for the loan that I am giving you in the form of government security. So banks beyond the SLR, if they have extra security, then using that security, they can borrow money from the Reserve Bank of India. They might have a huge stock of government securities because they want to make secure investments to improve the rating of their loans. the banks are rated according to the quality of their loans as well. So if they have more and more government securities, the quality of their loans is very, very high. Because if they give a loan to government, they'll definitely get it back. Whereas if they give a loan to a private business entity, the risk factor may be higher. So their loan portfolio will come down. The quality of their loans will come down. So in addition to the SLR itself, they would have huge quantities of government securities. Using those government securities, they can mortgage it to the Reserve Bank of India and take a loan from Reserve Bank of India. Okay. Now, while reading it in various textbooks, you may find repo rate being defined as it is the rate at which banks borrow from Reserve Bank of India. But I have very specifically said it is the rate at which RBI lends to banks. Both have the same meaning, but there is a difference in the use of wording. When you say RBI lends to banks, who is the deciding entity there? RBI is the deciding entity. When we say banks borrow from RBI, who is the deciding entity there? The banks are deciding whether to borrow or not. So it is not the banks who are controlling this. The RBI will say in this week on Friday, we are ready to give a loan through repo mechanism. If you want, you can come and borrow. So banks cannot go and demand to RBI says, I want some money, give it through repo. No, repo is a mechanism which RBI opens up when it feels like it is necessary. When it feels there has to be more money in the economy, it brings it that money through repo mechanism. Okay. So that is why I defined it that way. Now, what is the definition of reverse repo rate? It is the rate at which RBI accepts deposits from banks, or in other words, RBI borrows money from banks. It is the rate at which RBI accepts deposits, in bracket you can write borrows, money from banks by mortgaging government securities or other accepted securities. So in this case, the RBI is having to mortgage. RBI is taking money from bank, so RBI has to mortgage from its government securities. It has to give an equivalent value to the banks, saying I am taking money from you, but I am giving you a government security. Okay. Okay. It might have a negative impact there. But RBI will suffer that negative impact because it is doing this for a different purpose. It is not doing this because it is falling short of money. See, here RBI is borrowing from the banks. You would wonder why would RBI borrow from banks or why would RBI accept deposits from banks? The only reason RBI does that is because RBI wants the banks to have less money. So RBI is saying, I'm willing to take money from you. If you don't have other places to give loan to, you can give it to me. So RBI will have to pay an interest on this. What is that interest? That is the reverse repo rate. RBI is willing to pay an interest and take money from the banks when RBI doesn't even require that money. RBI is not a business entity. RBI is not going to give loans to anyone else. Why is RBI doing it? Only so that it can maintain the money supply in the economy. So it will suffer a loss there. It will bear that loss because its role is to control the money supply in the economy. Okay. So that is repo rate and reverse repo rate. Okay. These specifically, the repo rate is also called as monetary policy rate or simply policy rate. Repo rate is also called as monetary policy rate or policy rate. What is monetary policy? It is the equivalent of fiscal policy. Government's policy is fiscal policy. RBI's policy is monetary policy. Just an extra point you can note somewhere else. If monetary policy results in increase in money supply in the economy, we call it as cheap money policy. When monetary policy results in increase in money supply in the economy, we call it as cheap money policy. Cheap money policy, CHEAP. Suresh, 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 cut ஆயிடுச்சு. ஸ்கிரீன் மட்டும் போயிருக்குன்னு நினைக்கிறேன். Okay. So why is it called as cheap money policy? Because the way that RBI tries to increase the money supply in the economy is, if it reduces this rate, if it reduces the repo rate, what happens? Loans are available to the banks at a lesser rate than previously. So banks will borrow more and more. So what is happening to the loans? Loans are becoming cheaper, hence cheap money policy. Okay. When repo rate is reduced, loans are becoming cheaper. Loans from the RBI is becoming cheaper. As a result, banks tend to borrow more and hence money supply with the banks increases. That is when it is following a cheap money policy, equivalent of expansionary monetary policy. But we saw that to control inflation, this is not what is done. It is contractionary fiscal policy that is done. Right? Similarly, what is done is, when the repo rate is increased, what happens? Banks will borrow less from the Reserve Bank of India. That is called as dear money policy, a monetary policy which results in decreased money supply in the economy. A monetary policy which results in decreased money supply in the economy is called as dear money policy. You can also say it is called as tight money policy. This can be called as loose money policy. DEAR, dear. Dear is the opposite of cheap. Cheap is less expensive. Dear is more valuable. Something that is dear to us is very valuable to us. Loose money policy, because RBI is very loose with respect to how the money is going out. Tight means RBI is having a greater hold over the money. So tight or loose money policies are also words that are used. So I've already given you the answer. If Reserve Bank of India wants to reduce the money supply available in the economy, it will raise the repo rate. When it raises the repo rate, banks will borrow less. Okay, that is one direct way in which repo rate affects the money supply in the economy. Okay, now tell me how reverse repo rate would work. What would happen to reverse repo rate? I have told you what is reverse repo rate. There is no doubt about it. You have written it down there as well. What will happen to reverse repo rate, or what should happen to reverse repo rate if the RBI wants to control the money supply in the economy? Should the reverse repo rate be increased or should the reverse repo rate be decreased? Think and give me the answer. It is very, very evident. Increased. I said, see, to reduce the money supply in the economy, repo rate is increased, I said. Reverse repo rate also increases is what you're saying? Okay, now tell me others. Think and tell me. Radhakrishnan, yes, the definition of dear money policy is a monetary policy which results in decrease in the money supply in the economy is called as dear money policy. Okay, so I am getting mixed answers from here. What is the general answer? Ashwant, right? Your answer is it increases. Any change there? No. Anyone else? Are you able to get a hang of it? You walked in a little late. What is your answer? Don't know is an acceptable answer here. Don't know is fine. Don't know is your answer? Not sure. What about you? Think, you? Increase or decrease? Increase. Okay, one more person says increase. Increase. What about you? Increase. Okay. So I'm getting a variety of answers here, increase and decrease, and both are mixed in the audio, in the audience. Now, all of those people who are saying decreased, are you falling for the trap of the word reverse over here? Is that why some of you are answering decreased? The answer is increases. It also has to increase. Okay. Why increase? I'll tell you. Now, Reserve Bank of India increases the repo rate. Borrowing from RBI becomes costlier, so less people will borrow. The amount of money supply in the bank will not increase. It prevents the bank from borrowing. Now, if reverse repo rate is increased, what happens? It becomes more attractive for the banks to come and deposit money with the Reserve Bank of India. Because RBI is offering a higher interest rate. So bank will come and deposit more money than in the past with the Reserve Bank of India. Once again, reducing the money supply available with the banking system. If the reverse repo rate goes down, some of you are saying reverse repo rate is to be reduced. If reverse repo rate is reduced, it is not attractive to deposit money with the RBI anymore. As a result, what happens? More money remains with the bank itself. A decrease in reverse repo rate leads to more money in the hands of the bank itself, which results in increased money in the economy. So increase is the correct answer. Okay. As a general rule to you, I can tell you something. If one rate increases in the economy, and this is the monetary policy rate, right? Theoretically, all other rates in the economy should also increase. Theoretically speaking, all other rates should also increase. Okay. I'll explain the theoretical concept to you in a while. One more question I want to ask with respect to repo and reverse repo rate. Of these two, which rate would be higher? Will repo rate be higher or reverse repo rate be higher? Can you tell me? So Helen has given me the answer. It is correct. Confidence, very important. You say repo. You say reverse repo. Repo rate. Not sure. Think. You will be able to figure out. What about you? Reverse repo. After deep thinking, you are saying the wrong answer. Now, repo rate will be greater. I'll tell you why repo rate will be greater. Now, think of RBI or think of a bank in general. Okay, a bank is accepting deposits. A bank is giving out loan. Okay, or in other words, a bank is borrowing. A bank is lending. Which rate will be greater? It borrows at 5%. For it to make any sort of profit, it has to give it 6 or 7 or 8 or 9%, 8%. Why 8%? It has to manage its operational expenses, pay to its staff and all those, and then make a little bit of profit. So it may borrow at 5 and it may lend at 8. So it makes a little bit of profit. So always the rate at which they lend is going to be greater than the rate at which they borrow. Okay. Now think of RBI. RBI is borrowing at reverse rate. RBI is lending at repo rate, which should be greater. Repo rate should be greater. Now, what will happen if repo rate is lesser than reverse repo rate? Banks will borrow from RBI and give a loan to RBI and earn a profit out of it. It can happen, right? Banks will borrow from RBI and using the same money give a loan to RBI and make a profit. And RBI would be making a loss. It doesn't make any sense for them to do that. So obviously, you might think RBI is not a bank, RBI's intention is not to make profit. All that is true. RBI's intention is not to make profit. But RBI, why will it go out of its way and say, okay, I am ready to make a loss? No. If there is an opportunity for profit, they'll also make profit. That is what is happening here. And if they don't take that opportunity, others will misuse that opportunity to rob RBI. That is what will happen. So repo rate will always be greater than reverse repo rate. Logically speaking, this is the logic involved there. Otherwise, banks could easily borrow and then give a loan to them and then make money out of it. Lending rate would always be higher. Keep that in mind. Okay. So, our repo rate is greater than reverse repo rate. No doubts about that. And both the rates work in the same direction. That also you shouldn't have any doubt about. Now, consider this, the theoretical scenario that I was talking about. So what is repo rate? There is, okay, fine. I'll just erase this for a moment. So we have the Reserve Bank of India. We have the bank. Bank is the central character in all these, okay? Because bank is the entity which deals directly with the people. So bank is the central entity here. Bank has to give loans. See, ultimately repo rate and reverse repo rate, all these are meaningless if the bank doesn't pass on these effects to the people. If the bank gets money at a higher rate from the Reserve Bank of India, logically it also has to give a loan at a higher rate. If it doesn't do that, if it gives the loan at the old rate itself, then the monetary policy is ineffective in the ground. Okay, so that is, we are hoping that the bank will pass on. So the bank is the central character in all these. RBI makes policies, bank is the one which is actually implementing those policies in the ground level. So bank Bank interacts with all these entities. Bank is the entity which interacts with RBI. Bank is the entity which interacts with households and businesses. So which we will call by the name public. So bank is the entity which deals with other financial institutions, let's say banks separately and other non-banking financial institutions. So it deals with all these entities. Why have I written all these? Bank tries to get deposits from the public at the lowest possible rate because the public never has a profit motive. Okay, so it tries to get at some rate. The banks, it tries to get if it doesn't have enough money. You remember we spoke about something called as call money or term lending from other non-banking financial institutions in M3. So first it will try to borrow from other banks. If it doesn't get enough money from there, it will try to borrow from non-banking financial entities. So public gets the least amount of interest when they lend money to the banks. Let's say public is getting 4%. Okay, so banks would charge maybe 5%. Let's say NBFCs, non-banking financial institutions, will charge 6%. Okay, you remember I also told you that RBI acts as a lender of last resort for the banks. Functions of RBI, lender of last resort, which means RBI will allow the banks to borrow from them only as a last resort measure. Okay, how to ensure that? How to ensure that banks do not come to RBI at the drop of a hat? RBI will charge the highest rate in the entire economy. Reserve Bank of India will charge the highest rate in the entire economy to give a loan to the bank. So it will be a rate greater than 6%. If it is, let's say, 5%, what will happen? The bank will try to get money from the public. If it doesn't get, it will directly go to RBI. It will not try to get money from other sources. Then RBI will not be a lender of last resort. RBI will be a lender of second resort. Public first and then RBI. And from the public, the bank is not, the money is not available on demand. If the public is willing, they will come and deposit. But money is available from the RBI, may be available from the RBI on demand. So to ensure that banks come to RBI only as a last resort, the repo rate is likely to be greater than all other rates. Okay. Now, using all this money that it gets from here, the Reserve Bank of India gives out loans. Okay, it gives out loans. Let's say it gives out loans at 8%. Now, let's assume that the Reserve Bank of India increases the repo rate to 8%. Increases the rate to 8%. Now, the non-banking financial companies, they get to know about this because they also know what is happening in the economy. They know that now if NBFCs charge anything greater than 6%, let's say NBFCs charge 7%, they know that the bank will never borrow money from them because they can borrow from the Reserve Bank of India. So they will be forced to charge a rate which is lesser than what RBI is charging. Now, when RBI increases this rate, NBFCs know they can also charge a higher rate. Banks will know they can also charge a higher rate. And ultimately, although public may not have much of a demanding role over here, the public will also end up getting a higher rate. So one rate is increased by the Reserve Bank of India, all other rates automatically increase in the economy. And when the borrowing becomes costly, the lending also becomes costly. All the rates in the economy is increased. Now there are two effects over here. One, lending becomes costly, as a result of which less people will borrow money. So RBI's intention is not to leave less money in the hands of the banks. RBI's intention is to have less money in the hands of the public, because public is what is money supply. Public using the money is what is leading to high demand and inflation. RBI wants people to have less money. So, but RBI cannot directly impact the people. RBI can only impact the banking system. So by raising all these rates, the loans become costlier and less people borrow money, or the same people borrow money but less amount of money they borrow. That is one effect. The second effect it has is depositing money with the banks is now more attractive. So people who were earlier intending to buy some commodity, they would think, okay, let us not buy this now. If we put this money in a bank, it is more attractive for us. We are earning more. So more and more people could deposit money in the banking system. Money in the bank increases, but money in the hands of the people decreases, thereby reducing the money supply with which people can demand more and more commodities. So double effect. One, borrowing reduces. Second, deposits increase when the rates are increased. This is how RBI tries to control money supply in the economy. Hmm? Sorry? Bank depositing in? Public. That will also increase, no? No, there is no compulsion for any of this to happen. That's why he began this by saying theoretically this is how it is supposed to happen. Theoretically, okay. Why it is likely to happen is because as part of public we have two entities. We have households and we have businesses. Okay, two entities are there. Why do I say public will also get a higher, may also get a higher money over here? Because bank is not one entity. There are numerous competing banks, right? So everyone tries to get more and more money from the people so that they can give out more and more loans, because only when they borrow money they can give out loan, only when they give out loan they can make a profit. So there will be some bank or the other which will think I can get more money if I offer a higher deposit to the higher rate to the public. So when that happens, there is a potential for them to pay a higher money to the public. So some bank will raise the interest rate that they give. For example, now I don't know whether you have been following this. There is this Kotak Mahindra Bank, right, which has been more recently launched. They are saying that for savings deposit they are giving 6% or 7%. No other bank is offering that. Everyone is offering only 4% or 3.5%. They are saying for savings deposit they are offering 5 or 6%. Why are they offering that? Because they don't have customers right now. Initially, to attract customers, they are giving such offers. So similarly, some bank or the other will offer a higher rate. When they offer, the rest of the market will also have to follow suit. This is why competition is very important in any entity. Competition will ensure that the best prices are maintained and these efforts are passed on. Chandramohan, I'll come back to your question. Okay. All right. So in addition to this measure, there is also one more thing that is happening over here. What is that one more thing? As an additional mechanism to reduce money, the RBI says that the banks could also lend to the RBI itself. Earlier, let's say it was giving at 6%. Now it is giving at 7%. Earlier they were depositing, let's say 100 rupees. Now they might deposit 120 rupees with the Reserve Bank of India. Okay. So in both ways, it reduces the loans given out. It increases the money taken as deposits. It also increases the money. This is repo rate. This is reverse repo rate. When reverse repo rate increases, more money goes into the Reserve Bank of India. Banks are induced to give more money to the Reserve Bank of India. Okay. All right, Chandramohan, your question. Sir, one doubt. In order to control inflation, RBI increases repo rate so as to get access to money from banks. No, that part of your explanation is wrong, Chandramohan. When repo rate increases, RBI doesn't get more money. Banks get less money from Reserve Bank of India. When this happens, banks borrow less money from Reserve Bank of India. That is what happens. Okay. Then the second part of the question, going with the above mentioned logic, then how come reverse repo rate increase? When reverse repo rate increases, interest rate at which RBI borrows money from the bank will increase, which means that banks find it attractive, even more attractive than previously, to deposit money with the Reserve Bank of India. Once they deposit money with the RBI, the amount of money they have to give out as loan to the people reduces. That is how it reduces the money supply in the economy. No, see, why should reverse repo rate be higher? You are saying reverse repo rate should be higher than repo. My question is, why should it be? No, it is not a question of. Okay, I'll just answer her question, then I'll come to your question. Go on. Ask me once more. What is your logic? Correct. Okay. Okay. Now, that is the interesting bit over here. If you look at the actual rates with respect to this, when they give out a loan to other entities, okay, they'll be giving out a loan at 9 or 10 or 12 or 14% when they give out loans to us. When they give a loan to RBI, RBI will only be giving them say 5.5%, 6%. So what RBI offers to them would be lesser than what the public would be offering to them. It might not make sense to you right now. Why does it not make sense? Because when the safety of a deposit is high, the returns are going to be low. The safety of the money that they deposit with the Reserve Bank of India is very, very high, 100% secure. So RBI will offer them lesser return than the returns offered by public. When we go and borrow, we are not 100% secure. We might go and lose the money somewhere. So we will have to pay a higher interest rate, only then will they give a loan to us. Okay, which makes from a bank, from purely commercial perspective, it doesn't make any sense to give a loan to RBI. It makes all the sense to give a loan to other entities. But still, why do they give a loan to RBI? Because that is safe investment for them. It is money given to them which is safe. But now, how does this control money supply? Earlier at 6% rate, let's say, they were giving only 100 rupees. They were giving 100 rupees here and they were giving 900 rupees over here. Now at 7%, they may be giving 150 rupees over here and 850 rupees over here. That is all that will happen. It is not that they are going to go and give the entire money to Reserve Bank of India. An economy doesn't work like that. Little more than previously. That is all that is there. So now your question only compares the rate offered by RBI versus the rate offered by the public, or the amount that the public has to pay. Your question is not a comparison of repo and reverse repo. Do you want to compare repo and reverse repo? If you want to compare that, the logic still continues to be this. If the reverse repo rate is higher than the repo rate, what will happen? RBI will be borrowing at a higher cost and will be giving loan at a lesser cost. Now imagine you are a bank. What would you think? Let me borrow money from RBI at lower rates at 6% and let me lend it to RBI itself at 7%. In that circular manner, they'll earn money and go. So to prevent this from happening, see, repo, reverse repo, there is no compulsion that repo rate has to be higher. But if repo rate is not higher, two things happen. Banks can earn this way. When banks earn this way, who's actually losing? The RBI is losing. And RBI is also, see, RBI might be regulating money supply whereby, money keeps circulating within RBI and the bank, but RBI will end up having no money at all of its own. It will lose all its profits or it will end up making a loss. It may not have the money to pay to the bank ultimately. If an organization is suffering from loss, they will not have any money left with them. Once they have no money, once they are in a position to not repay the loan, they don't become a trustworthy source anymore. So no one will give a loan to them. The safety of that loan will be lost. So it is very essential that RBI is a profitable organization for them to manage money in the economy, for which they have to go by profit-making logic, which is lending rate has to be greater than borrowing rate. Absolutely not. There is no compulsion on any bank to resort to repo and reverse repo mechanisms. Banks, if they feel that they don't need to depend on Reserve Bank of India to get more money or to protect their money, they need not resort to repo transactions. It's a choice that they have. And it's a choice that they take because of the safety afforded by Reserve Bank of India. Your question also answered? Okay. So do the banks lend money to RBI instead of continuing to lend more loans to the public only because of safety returns factor? Absolutely, that is the reason. Okay, your question is answered. Great. All right. Now that is about repo rate and reverse repo rate. Now there is a link here as well. Because all these rates work in the same way, generally what RBI does is, RBI has a committee called as Monetary Policy Committee. When the Monetary Policy Committee meets, what the Monetary Policy Committee does is, they only announce the repo rate. And they say, they would have already told, there is a link between repo rate and reverse repo rate. So in the past, let's say 4 or 5 years ago, the link was that whatever is the repo rate, the reverse repo rate would be 100 basis points lesser. Okay. Do you know what is basis points? You don't know, right? I'll teach you at the end of the class. It's not directly related to the topic. It's just a mathematical concept. I'll teach you at the end of the class. So the idea is, if the repo rate is 6%, the reverse repo rate would be 5% automatically. Or in other words, it will be 1 percentage point. This percentage, the difference will be 1. 1 percentage point is equal to 100 basis points. It's like saying 1 rupee is equal to 100 paise. It's the decimal part and whole number. Okay, so 6%, this has to be 5%. If this is increased to 6.5%, no need to separately mention, by default reverse repo rate will be 5.5%. If this is decreased to let's say 5.5%, by default this will be decreased to 4.5%. The gap between them will always be 1 percentage point. There is a rule, there was a rule like this. A few years ago, 3-4 years ago, they changed this rule and they said the gap is going to be 0.25 percentage point, or in other words 25 basis points. So if this is 6, this will be 5.75. If this is 5.75, this will be 5.5, and so on and so forth. That was the case. This link I don't think currently exists because of the COVID situation. RBI independently announced both repo separately, reverse repo rate separately, but in general there is a link. Keep watching the news or check RBI website for what the current link is. It could change from time to time. Okay, so I don't want to give you stated facts. Some of the textbooks will tell you the difference between them is always 1 percentage point. That was not true. That is not true. That changed a few years ago. They reduced it to 25 basis points. And right now, I don't think there is a clear link between them. They have not re-established the link yet, but they will. Very soon they will, because it's very tedious for them to announce both separately. It's unnecessary also. It gives, if there is a clear link, it gives predictability to the entire market, that if one is announced, the rest is also understood. Okay, even here I said this is very, very theoretical. I think you're still writing. I'll just wait for a moment. Okay, Niral says currently it is 4% and 3.35%. So I'm not sure about the numbers, but he says it's currently 4% and 3.35. So the gap between them is actually 65 basis points. You don't have to worry about the facts here. You don't have to worry about these numbers. Don't write it. But you just type repo rate RBI. You will just Google it. You will find the RBI website, and they would have clearly mentioned what is the CRR, what is the SLR, what is the repo, what is the reverse repo. Everything is mentioned in their website itself. Or you can just go to RBI website, scroll down. There is a link called as I think rates in the economy. You click on that, it will drop down, and you will have the list of various rates in the economy. Okay. Or simpler still, you keep watching the news. Once every 2 months, Monetary Policy Committee meets. Okay, beginning of the month they meet, MPC, Monetary Policy Committee, and the day after they meet, the news will be there in the front page or in the economy page. It will be there. What is the repo rate? What is the reverse repo rate? The latest will be there. Why do I ask you not to memorize it? Because every 2 months it could change. It's not worth memorizing all those. Have a general idea about what the rate is like, around 4%, around 5%. That is enough. Yeah, so what I was saying is that generally what happens when RBI increases the rate, the bank also increases all other rates. Okay, maybe not by the same extent. They increase by 1, they may increase by 0.75 or 0.8 or something like this. In what he asked is very relevant. If all the banks come together and they form a decision that we are not going to increase the rates of the public, if there is no competition among the banking system, if there is a collusion among the banking system, then they may not increase these rates. This rate particularly they may not increase, and they may keep it at 4% itself, which the RBI still finds to be not very harmful. But what they find to be harmful is that when the RBI reduces this rate from, let's say, 7% to 6%, assume that it was originally at 7%, they reduce it to 6%, they'll reduce this from 4% to 3%, because it's available at 6%, no one will get from NBFIs. So from 6 it will be reduced to 5, from 5 it will be reduced to 4, from 4 it will be reduced to 3. Any given opportunity to pay less to others, they'll take up that opportunity. What they are not doing is, they are not passing on this reduction over here. When the RBI reduces 8 to 6, it was originally 8, right? Instead of reducing 8 to 7, they are only reducing it to from 8 to 7.75 or 7.5, which means RBI is passing on a benefit of 1 percentage point. They are only passing on a benefit of 0.5, half of it or less than half of it. This is a major criticism that is there of the banking system itself. Monetary policy, which is targeted at the public, through the banking system. The RBI brings about a monetary policy, the banks are not passing it on effectively to the public, especially in terms of decrease in monetary policy. Increase they are passing it on, but decrease they are not quite passing it on. It is one of the criticisms that is there of the banking system currently. How to overcome that? We have a couple of more topics in this whatever we are discussing now. After that, we'll take a look at monetary policy transmission mechanism. Just because we discussed this, I'm introducing that concept to you. Okay. Now, liquidity adjustment facility is also done. That was number 3. Number 4. Something called as marginal standing facility. Is repo at the discretion of the bank or at the discretion of Reserve Bank of India? Repo, borrowing through repo, is it at the discretion of the bank or at the discretion of Reserve Bank of India? No, I gave you the answer already. I told you there is a reason why I have defined repo rate at, it is the rate at which RBI lends, not the rate at which banks borrow. It is at the discretion of Reserve Bank of India. The Reserve Bank of India, to have a level of predictability in the economy, they'll make an announcement that every Friday or every alternate Friday we'll engage in repo transactions. RBI gives a timetable to the economy saying that on these dates we'll engage in repo transactions or reverse repo transactions. But that is the prerogative of Reserve Bank of India. There is no compulsion on them to do that, and there is no demand that the banks can go and make saying, I want money now, please open repo transactions. They cannot. RBI decides it. If that is the case, how can we call RBI to be a lender of last resort? What do you mean by a lender of last resort? I require money, I try elsewhere, I am not able to get it. I should be in a position where I come and ask you, give me some money, and you should be giving me money. Only then can you be a reliable last resort. If let's say I am a bank, I definitely need money, then whenever I ask, you should be able to give me that money. Only then you are a reliable last resort. So repo is not the means through which RBI can be considered as a lender of last resort. That is where we have something called as marginal standing facility. Marginal standing facility is also defined the same way as repo, but this time we'll change the definition slightly. Okay, it is the rate at which banks borrow from Reserve Bank of India. It is the rate at which banks borrow from Reserve Bank of India by mortgaging government securities and other accepted securities. Now there is a point I missed out on mentioning earlier. Okay, thank you. So many answers saying RBI's discretion. Very good. There is someone, Helen, who asked the question, will repo be short term? I missed out on mentioning that. I remembered in this context. Okay. All these repo, reverse repo, your marginal standing facility, all these are very, very short term transactions. How short? 1 day. You remember call borrowing that we spoke about? These are rates which are applicable per day. When we say 5% is the repo rate, it is 5% for that day's transaction. If banks take a loan from RBI, on a daily basis, they have to pay 5% interest. Whereas when we deposit money to the bank, on a yearly basis, they pay us 4%. 4% is per annum. But repo, reverse repo transactions, it's per day basis that the interest is calculated. Of late, RBI has introduced longer duration repos also. They have introduced 3-day repo, 7-day repo, 30-day repo, which means that the interest rate associated will be for that duration. More recently, RBI introduced 1-year repo as well. Whatever is the repo rate, it will be for loans calculated on a yearly basis. Now imagine 100 rupees you borrow, per annum you have to pay 10% interest, means at the end of the year you have to repay 110. Per day you have to pay 10%, means every day you have to pay 10% interest, which means in a matter of 10 days you would have paid interest of 100 rupees. That is how expensive it is for the banks to borrow from Reserve Bank of India. And that is how much they will get by depositing money with the Reserve Bank of India as well in reverse repo rate, because it's again a daily transaction. Makes more sense to you now? a little more in terms of how much banks are earning and how much RBI is earning from this entire process. Okay, so it is a daily concept. Why is it a daily concept? It's very difficult for us to understand this concept of daily interest loans. It is, from a business perspective, it is very easy to understand. Primarily, banks resort to borrowing from RBI only when they absolutely require money, where they are not able to get money from anywhere else. When they don't have another option, that is when they would resort to even repo transactions when RBI makes it available. Okay, so when that happens, what the banks do is that for banks, it is liquid money on demand. I mean, whenever it is available, they can go and access it. Especially MSF is on demand. Okay, they try to get money from the public, they are not able to get money. They try to get money from other banks, they are not able to get money. They try to get money from NBFCs, not able to get money. In that, and RBI has not made any repo transaction open at that moment. Maybe there is 2 more days to go for repo transactions. Bank finds that at the end of the day, their balance sheet is in trouble. You remember call money that I said, when it is not able to balance its balance sheet. So it definitely needs to borrow. At that time, at the end of the day, it can go to Reserve Bank of India and say, I need some money for balancing my balance sheet. So can you lend me some money, which the bank will repay the next morning, because once again, the money it cannot keep for long because it's very, very expensive. It will give back to Reserve Bank of India. It is the responsibility of the banks to maintain that balance sheet. Because they have failed to maintain, they are in a position where they are having to borrow from the Reserve Bank of India. Okay, RBI will give, it is more like a punishment. This interest rate will be more like a punitive interest rate. It will be very high. Because you fail to meet your obligation, you are having to borrow at very high interest rates. As a result, they will borrow, they'll give back the next day, and because it's an emergency situation, the banks are even allowed to use their SLR securities to borrow. I told you there is an exception. SLR cannot be used for any kind of borrowing except MSF. In marginal standing facility, they can use even their SLR government securities as a pledge to borrow money from the Reserve Bank of India. Okay, so that is MSF. Definition is the same as repo. Duration is also the same as repo. Interest rate is higher than repo. Why does this one alone have a very weird name, marginal standing facility, other than repo? And why does repo have that name, repo? Any idea? If you look at the word repo, repo is a short form of repurchase option. What is the repurchase option? The government securities that it is pledging. We said it is the rate at which RBI lends to banks in mortgage of government securities, which means government securities comes into the hands of RBI and money goes into the hands of banks. It is very difficult in general for anyone to get hold of government securities because they are so much in demand, they are so safe, it is very difficult. So when the banks are giving those government securities, they get into an agreement, they have an option of paying back the money and getting the securities on a pre-agreed date. On a pre-agreed date, there is an option to repurchase the security that they had given as mortgage, they can get it back. So that is the repurchase option, shortened as repo. Reverse repo means because the RBI is the one which is going to repurchase, so it's reverse repurchase option. I think that answers your question, Helen. So they do have a repurchase option. Whatever is the duration of that repo, according to that, they have a repurchase option. Now, what is marginal standing facility? Why the name marginal standing facility? Marginal refers to the fact that only a very small portion can be borrowed in this way. It is only for the purpose of balancing their balance of payments. So there are regulations from time to time. Last I checked, it said only 1% of NDTL. It may have varied now, but only 1% of their NDTL. What is NDTL? Net demand and time liabilities that we saw, total deposits that come in, only up to a value of 1% of their total deposits can they borrow from Reserve Bank of India in the form of this marginal standing facility. So only a fraction, that is what is referred to as marginal, only a very small portion, marginal. Why the word standing facility? What is meant by standing facility? I don't know whether you have had this experience. Okay, you know Amazon Prime, right? I can tell you from that experience. In Amazon, if you take a monthly subscription, Prime subscription, so it provides you have to enter your account number, and they normally how it works is that you also have to give an agreement to them that at the end of a cycle, they'll automatically deduct money from your account. Okay, unless you go and unsubscribe. Which means as long as you don't unsubscribe, the money keeps on getting deducted from your account on a monthly basis. So this happens because you have given them an approval to by default deduct the money from your account. This is called as a standing instruction. Till I go and change that instruction, the instruction that I have given once stands all the time. Okay, so this is applicable in banks also. If you are repaying a loan, every month instead of remembering to repay a loan and going and paying, you can give an instruction to the bank that on this particular day you can withdraw amount from my bank and directly use it for loan payment. So you don't have to worry about repaying your loan. If it is there in the account, they'll automatically deduct the money. So that is also a standing instruction. Similarly, here standing facility means at any given point of time, every day, at the end of the day. So how do I say end of the day? At 5 o'clock or 5:30 is what this facility is available. Every day at 5 o'clock or 5:30, this facility will be available by default. RBI doesn't have to separately declare that on Friday we are having a repo operation. That is not a standing facility. RBI has to declare that it is going to be there. But here, every day by default, it is going to be there. There is no need to separately declare that banks can come and borrow. That is why it is a standing facility. So on a daily basis, as a last resort, banks can go here and borrow. Marginal standing facility. Correct, exactly like EMI getting deducted. Correct, Asha, I did say that. Now, why is that an issue? So in repo rate as well as in MSF, government securities or other accepted securities have to be mortgaged. In repo rate, they could not use SLR securities. Here, because it's an emergency situation, it's only one night, overnight facility, borrowing facility, they can use SLR as a mortgage because the next morning itself, they'll pay the money and get it back. With repo, they may not give back the money in one day. Although the duration says 1 day, remember when we spoke about call money, we had said this, they might take the money for 1 day at an interest of daily interest rate of 6%, but they might agree on repaying it after 7 days. Just that every day they have to keep paying that amount of interest. So interest calculation is on an overnight basis. Here the borrowing itself generally happens on an overnight basis because it is only an emergency situation. And this rate is also higher than the repo rate. This is the highest rate in the economy. Okay, this is the highest rate in the economy. So how does it work? There is repo rate. There is reverse repo rate. And on the top we have marginal standing facility. Prior to COVID, how it was working was that if a repo rate is 6%, reverse repo rate would be 5.75% and MSF would be 6.25%. The link between this and the link between this was the same, 0.25. This would be 0.25 higher, this would be 0.25 lesser. This was the link prior to COVID. But with COVID, everything has changed. So Niril tells me it is 4.25. Currently, going by what he said, this is 4.25. This is 4, this is 3.35. So it is all haywire. Don't have to worry about that. Don't go with what the COVID numbers are. Wait and see. By the time maybe a month or two before your exam, it should probably settle down. In the next couple of months, it could probably settle down. So you will have a better idea of what the rates are. Just keep reading the news about Monetary Policy Committee and their decisions. You will get to know what is happening here. Okay. So that is marginal standing facility. Number 5, we have something called as bank rate. You look at it and you might think it is the rate at which banks lend to the people, but it is not. Bank rate is the rate at which banks borrow from Reserve Bank of India. Bank rate is the rate at which banks borrow from Reserve Bank of India. Same definition as repo, same definition as MSF. The difference comes here. By mortgaging commercial papers, bills of exchange, etc. Okay. Now, what are commercial papers? What are bills of exchange? We haven't discussed. We will only be discussing it in the financial markets class. To give you a general idea, these are the equivalent of T-bills but issued by private companies. You know T-bills, right? Short-term borrowing instruments of Government of India. These are short-term borrowing instruments of private companies. When private companies want to borrow for a short term, they issue commercial papers. Okay, this is directly borrowing of money. Bills of exchange is not actually direct borrowing of money. Sometimes what happens, traders, when they get their raw materials, they would not have enough money to pay their supplier. So what they would do, with the authority of a bank in which they have an account, they would issue something called as a bill of exchange, saying that I have borrowed so much of equivalent of raw material from you, 1000 rupees equivalent of raw material from you. Instead of paying you the money now, I'll be paying the money after 30 days, for which I'll be giving you an interest of 7% or 8%. So it is, instead of borrowing money, they are borrowing raw material supplies and they are making a delayed payment for that, which is authorized by a bank. Okay, so that is called as a bill of exchange. This bill of exchange can be used. So you are the one who, let's say he is the one, Ashwant is the one supplying to me. I'll issue a bill of exchange to Ashwant. Ashwant can use this bill of exchange as a proof of money to borrow from some other bank. So banks accumulate a lot of bill of exchange. Banks can use that bill of exchange as a security to borrow from Reserve Bank of India. Okay, so that is how bills of exchange work. As a producer, I borrow raw materials from you, I issue bill of exchange. You can use that bill of exchange to borrow some other money from a bank. The bank can use that money to borrow from Reserve Bank of India. Okay. The difference between bank rate and other rates that we have mentioned over here is that bank rates are longer duration. They are not overnight facility. They could be for 1 month, they could be for 2 months, 3 months, up to 1 year it could be. Okay, longer duration. In some textbooks, you would find that bank rates are long-term instruments. Long-term generally refers to more than 1 year in economics. They are not long-term in that sense. They are longer than your repo or MSF facility. That is all. Okay, and the rate would be equal to MSF. Rate would be equal to MSF. The key difference is MSF is a daily interest rate. This is a longer term interest rate. If MSF is 6.5% for a day, this will be 6.5% for a month or for 2 months or 4 months. That is how it is. So this is how the link is. How? Very good question. Very good. That is the question that I wanted you to ask earlier also. So how are these things affecting the inflation? Okay. How are any of these things affecting the inflation? Repo, reverse repo, we already discussed. MSF and bank rate, it does not have an immediate impact or a very visible direct impact on inflation control, but the role that it has is that when the MSF becomes costly, the banks are more judicious with respect to the loans that they give, because they know that if they give out a loan and they have a mismatch in their balance sheet, then they will have to borrow from RBI at extremely high rates. When MSF increases, the call money rates from non-banking financial companies, the interbank lending rate, everything increases. Daily interest rate increases. So as a result, they know that before they give out a loan, they have to be very judicious if this increases. So it indirectly puts a pressure on the banks to be very careful about the loans that they are giving out on a day-to-day basis. That is the indirect role over here. With respect to bank rate actually has the biggest impact on the economy itself. Because this bank rate, when it is happening based on, let's say, something like a bill of exchange, or even a commercial paper, is actually having an impact on the day-to-day business activities. Okay, so RBI says the bank rate is going to be increased from 6 to 7%, let's say. Okay, which means that you as a supplier to me would be demanding a rate in correspondence to this, not 7%. Earlier, let's say you were charging 5%. Now you charge 6% from me. So what will happen? I might borrow less commodities from you, or I might not even borrow from you, or I might say I'm not going to use the commodities now, I'll take it later. So directly it is impacting the business activities in the economy. Okay, so as a result, bank rate has a great impact on what is actually happening in the economy. You remember about an hour or so ago, I made a point that in classroom, I tried not to discuss numbers as much as possible, because you might write down it as a fact and you might remember that all the time. And I also told you, concepts don't change frequently, numbers do. But sometimes concept itself could change. I told you, I'll give you an example later. Bank rate prior to 2000, that period was considered as the policy rate in India. This was the RBI's key policy rate in India. Its entire monetary policy was based on the bank rate. It's only in that early 2000s period that the concept of repo rate was introduced into India by Reserve Bank of India. So that is when we moved away from bank rate to the concept of repo rate. If you look at some of the early questions of UPSC, 2008, 9 and all those periods, if you look at the questions, almost on a regular basis, every alternate year, there would be questions about bank rate. Of late, there are no questions on bank rate because bank rate has lost significance and repo rate has gained no significance. So that is where the concept itself could change. Even today, if you read some old textbooks, you would find bank rate as the most significant rate. So that is wrong now. That is not relevant anymore. Definitely. Bank can deny a loan to the people, right? Yes. See, in some cases, that is exactly what RBI wants also. RBI doesn't, if there is already excess money supply in the economy, if there is a huge business activity, already a very high, a very positive business environment that is there, then there is a tendency for the bank to give out loans unnecessarily. Anyone comes and asks, the bank might issue a loan because they think every business is succeeding. Let us give a loan and earn money. There, RBI wants the banks to be more judicious. There, RBI wants the banks to think twice before giving out a loan, because some of those businesses may actually fail. It is just a temporary enthusiasm that people may have with respect to those businesses. It may not be really good ideas. We will learn about this in banking chapter, where we know we are currently in an NPA crisis. Why are we in that NPA crisis? It is a situation like this which led us to that NPA crisis. So where there, RBI intentionally wants the banks to not give certain kinds of loans if they feel that it is unhealthy. Helen is asking, bank rate impact on inflation. Could you please explain once more? Yes, Helen. So when we talk about bank rate is a rate set by the Reserve Bank of India, at which banks can borrow from Reserve Bank of India by giving bills of exchange and commercial papers. Okay, which means, what are these bills of exchange and commercial papers? Let's just take bill of exchange. Let's say I am a producer, I am getting some raw materials from Ashwant sitting over here. I would buy raw materials from Ashwant and give a bill of exchange saying, I'll give you money, I'm taking these raw materials I'll give you the money and an interest of, let's say, 8%. How do I decide that 8%? Because he can use that money to go and borrow from a bank. The bank will say, I want 9%, and the bank can go and borrow money from RBI. RBI will say 10%. But in this case, RBI is the one declaring first. RBI says, I am going to charge 8%. Bank will offer him only 7%. He'll offer, I'll offer 6% to him. If RBI raises this rate, then he will also charge a higher rate from me. If RBI raises the rate from 8 to, let's say, 10%, he will want from 6 to 8%, he might want from me. So borrowing from him or getting raw material from him becomes costlier for me. I might not take that raw material now, or I might not borrow that money. So I might reduce my business activity itself. That is how it affects. Okay. Assuming it's clear. Nishchit is asking, does invoice discounting also included here? Nishchit, I don't really know what is invoice discounting. If you could explain that to me, I'll tell you whether it fits in here. Okay. Great. Helen. Okay, so one more point to note here. Because repo rate is the anchor of all these rates. All other rates depend on the repo rate. Repo rate increases, all other rates increases. Repo rate decreases, all other rates decrease. So because of that, repo rate is also called as anchor rate. It's also called as anchor rate. Okay, so that completes our discussion on the various mechanisms by which Reserve Bank of India controls the money supply in the economy. Okay, these are the quantitative way, in the sense that RBI tries to control a particular quantity of money. RBI says there is 100 crore in circulation. I want to reduce it to somewhere in the range of 80 crore. So the quantity they want to reduce, they are directly attacking the quantity, be it OMO or variable reserve ratio or LAF, liquidity adjustment facility, or be it MSF or bank rate or whatever it is. They are trying to directly attack. Earlier someone asked a question, how does the government or the RBI decide which policy to adopt? If you look at this, you very clearly know that RBI doesn't have a lot of choice. For RBI, the primary measure by which it tries to control money supply in the economy is liquidity adjustment facility, where if it increases repo, automatically reverse repo also increases. So this is its first tool. Okay, but the impact of this is also felt with a time delay. First they have to increase the rate, then the banks have to increase the rate. There will always be a small lag of a month or two before the impact happens. If they want the impact to be immediate, then they are left with only one option, open market operation. Immediately, today they conduct, today they suck out all the money. So if they want immediate impact, open market operation. If they want a sustained impact in the economy, if they can wait for a month or two for things to stabilize, okay, then they'll go for repo and reverse repo. That is also more organic in nature. Here, the RBI is suffering a loss. By taking in the money, it is promising an interest payment. RBI is suffering a loss. So it will only resort to OMO when there is no other option, when it is urgent requirement. Conventionally, what they go for is liquidity adjustment facility. Very rarely, when they don't have any other option, when they want to make a systemic change in the system, that is when they'll go for your variable reserve ratio. Why so? Because variable reserve ratio primary purpose is not to control inflation. In fact, there was actually a conflict between the previous RBI governor and the government. Why? Because variable reserve ratio is something that is decided by the RBI. Okay, we will learn at the end of the class about this committee called as Monetary Policy Committee. Have I told you about Monetary Policy Committee? How is it composed of and all those? Have I told you? No. Just to give you an overview, Monetary Policy Committee consists of 3 members from RBI and 3 members from the government, which means the government also has a role to play in the discussions on what should be the policy rate, monetary policy rate. The name of the committee itself is Monetary Policy Committee. And in 2015, when it was set, it was very clearly said that the role of monetary policy would be to control inflation in the economy. Not the role of RBI. The role of monetary policy would be to control inflation. RBI will still have other roles in the economy, but monetary policy is towards controlling inflation. So the general understanding of the previous RBI governor was that only in deciding repo rate, monetary policy committee will have a say. Repo rate and reverse repo rate. But one of the monetary policy committee, the government members tried to change the variable reserve ratio. The RBI governor said there is no authority for this committee to discuss variable reserve ratio because it is outside the scope of monetary policy. And this became an issue between the government and the RBI governor. You know what happened? There was a lot of issue between those two, and eventually, due to obviously some personal reasons, the RBI governor had to resign and go. But whatever be the case, so it's a debatable area. Is this coming under the monetary policy or not? Strictly by the rules, it doesn't. But in various interpretations, some say it does and some feel it doesn't. So it is only a measure which is used when no other measure works, or when there is some other fundamental change has to happen in the amount of money in the banking system. Only then this is used. Like in the case of pandemic, CRR was reduced, something like that. Okay. All right. So what we have discussed so far are quantitative measures of controlling money supply in the economy, quantity of money to control it. There are also some measures taken by the RBI which are qualitative in nature. Qualitative measures to control inflation. Now, when we say qualitative measures to control inflation, the intention here is not to reduce the money supply. The intention is to ensure that whatever money is there is high quality money that is in circulation. Okay, which means that it tries to reduce the low quality loans that are given out. So any low quality circulation of money it wants to reduce. Now what do we mean by low and high quality over here? You will understand when I tell you what are the mechanisms by which it is done. So the RBI may introduce something called as ceiling on credit. The RBI may say certain portfolios of loans, certain portfolio. What do we mean by portfolio? Category. Portfolio means category, that's all. So different portfolio means different category. So what are the various portfolios? Housing loan is a portfolio, vehicle loan is a portfolio, business loan is a portfolio, education loan is a portfolio. So the RBI says certain kinds of loans, certain portfolio or category of loan, we are going to set an upper limit. You cannot give out a loan greater than this without permission from the RBI. They are not saying you cannot give out at all. If a loan is going to be above this category, above this limit in a particular category, you need to seek RBI permission before you can give out that loan. Lesser amount you can give. Okay. So the idea that the RBI is trying to convey there is, if the bank feels that it might go to RBI and get rejected, it means RBI would reject if they feel that this money may not come back. So the bank may not give out such a loan. Beyond that limit, they may not give out such a loan. Only when the bank feels that yes, this is a very credible loan, very high quality loan which will definitely come back, will they take it to RBI, and RBI might give an approval to that. So by putting a ceiling on the credit, RBI is trying to control the quality of the loans that are going out, which means in a way, indirectly, it affects the quantity of money as well, but not directly. So that is measures to control money supply through qualitative mechanisms. One is ceiling on credit, putting an upper limit on how much loan can be given in certain categories. That is ceiling on credit. Ceiling means putting an upper limit. Credit is loan. Yeah, how much can be given as a loan? Principal amount itself, they'll put a ceiling. So if you want to, let's say you want a housing loan, then the RBI may give an instruction to banks saying that the maximum housing loan that you can approve is only, let's say, 20 lakhs. Beyond that, you have to come and show proof that the person has the ability to pay and come and get an approval from us. So any loan request where the request is less than 20 lakhs, the bank will freely give. For greater than 20 lakhs, it will be more judicious. It will do proper due diligence into whether you have the capability to repay, whether your source of income is reliable. All this it will look. Only when it is convinced, it will go to RBI, take that request and then give you that loan. So it improves the quality of the loan that goes out. Second, margin requirement. Okay. Okay, so there's a question with respect to this. Prashant is asking, so the larger NPAs in crores were given to the individuals only after the approval of RBI? Prashant, not necessarily. It is not, I am not saying that there is always a ceiling on credit. The RBI can introduce a concept called a ceiling on credit when it wants to control the quality of the loans that are there. It is not available at all times. So if you find that a loan has been given to Vijay Mallya, you cannot assume that it is with RBI's concurrence that the loan was given. We liberalized the banking system in 1991, post 1991, LPG liberalization. After that, the banks were given the freedom to do the activities to a large extent on their own. Only in some circumstances, the RBI will intervene. So they can use a mechanism like this if they want to control, not that they are using it at all times. I hope that is clear. Now coming to margin requirement. If you have ever tried to get a vehicle loan, you would understand this concept really well. So you go to a car showroom, or you go to a bank directly and you say that I want to buy a car but on loan. They'll say if the value of the car is, let's say, 8 lakh, that's the value of the car. They'd say only 70% of this you will get us loan, or 80% or 90% in some case, if you can give proper proof and all those. Let us say 70% is what you can give us, you can get us loan. What is 70% of 8 lakhs? Will be 5.6 lakhs. 8 into 6, 8 into 756, yeah, 5.6 lakhs. Only 5.6 lakh rupees you will get as loan. The remaining amount you will have to pay out of your own hand as a deposit, as from your hand you will have to pay. You will have to find that money from somewhere else. You will only get a loan of 5.6 lakhs. Now, if the RBI wants to reduce the amount of certain kinds of loans that goes out, they may increase this margin. They may change this margin, not increase this margin. So the margin here is the 30%. 30% is the safety margin that they are asking. They may increase that margin, or in other words, they'll say we'll only give you lesser amount as loan, which means that they'll increase the margin from 30 to 40. Okay, 40% you have to pay on your own. So if it reduces to 60, so it means that you'll only get 4.8 lakhs as loan. The remaining you'll have to pay out of your own hand. Okay, or they may say if you want a loan of 5.6 lakhs, you should buy a car which is of a value higher than 8 lakhs. You have to buy a car of 9 or 10 lakhs value to get a loan of 5.6 lakhs. So there again the margin is changing. So that is called as margin requirement, where if the RBI wants to control certain kinds of loans, they may say increase the margin between, the gap between the loan amount and the value, that has to increase. So they might insist on that. Or they might say, even now we see this, right? If you are able to show proper proof that you have regular income, then you will get a loan up to 80 or 90% of the value of the vehicle. But if you are not able to submit proper proof, or if your salary is below a certain limit, they may say for your salary category we will only be able to give 70%, okay, or 60%. So that classification is there even today. So that would be margin requirement. Based on the quality of the one borrowing the money, they might have different rates. Then they do something called as moral suasion. So this is just moral persuasion. They are trying to morally persuade. The RBI from time to time gives moral science classes to these banks. That is all that is happening. They go and instruct the banks. These are all the best practices to follow. So your KYC has to be done. You have to treat your customers in this manner. Okay, you have to ensure that all these background things are done. So it improves the quality of banking. So in that sense, the banks will not frivolously give out loans or make false promises and all those. Again, it's a very indirect method. It may or may not have a bearing. This is not binding in nature. That is why it's called moral suasion. Just instruction, giving of best practices and all those. That is all that is happening here. And finally, one more thing that we have over here is, if none of this works, or if the banks are intentionally violating any law set by Reserve Bank of India, there is something called as direct action which can be taken, under which the Reserve Bank of India may actually take control over the bank and start performing the bank's roles on its own, like happened with recently Lakshmi Vilas Bank, or prior to that with Punjab and Maharashtra Cooperative Bank, or any of those examples, that Yes Bank also with that issue that happened and all this. In those cases, the Reserve Bank of India directly takes control over the bank when they feel that they are violating any of these norms, or the repo, reverse repo norms, or any of those if they are violating, or if the bank is continuously showing loss in all those scenarios, they might take direct action on the bank and start controlling the performance of the bank. So that also robs the bank of some freedom, and hence indirectly could affect the money supply that is there in the economy. These are all qualitative measures to control money supply in the economy. Okay. So the major topic of inflation is over. All we are left with is terms related to inflation. I'll start this with that monetary policy transmission mechanism that I spoke about. When RBI brings a policy to the banks don't pass it on to the people. What happens? What is the history behind it? I'll give you that. Then we have some other terms of what is inflation, what is disinflation, deflation, some terminologies associated. There is a concept called as stagflation, a concept called as Phillips curve. Then real versus nominal GDP, there is a concept called as GDP deflator, and then monetary policy committee as well. So these are some leftover topics. Do you guys want a break? A couple of minutes? Only 35 minutes left. Just a couple of minutes break. If you guys want, we can take, and then we'll do the rest of it. Half an hour should be enough for me to finish that. Do you want or do you not want? Don't want. Okay. Let me see online. The general response seems to be okay. General response seems to be to continue. Just a couple of people said break, so I'll continue. So I'll have to go with the majority view. Okay, this is one advantage of having offline class as well, because if looking at my face, people hesitate to say they want a break. Hey, on text, they can easily text, please give a break and all this. Okay, so I'll go with the majority view. I'm not giving a break. All these are applicable. There's a question. All these are applicable to banks only. Yes, these are applicable only to banks. These are not applicable to non-banking financial companies or other institutions. These are only the relations between the Reserve Bank of India and the banking system. Monetary policy transmission mechanism. Monetary policy transmission mechanism. That is the heading. So transmission means is the monetary policy which is between the RBI and the banks, is it getting transmitted to the people? That is the question. Is it getting transmitted to the people? That is the question. Okay, so this is the repo. Repo is the monetary policy that we are talking about. Is it getting transmitted to the people? To understand that, we need to understand what is the name of this rate which links the banks and the people. Okay, so what is the rate? Essentially, we want to learn what is the name of the rate at which banks lend to people. The lending rate of the banks to the people. Historically, I'll just do a quick recap of how historically it has been. After liberalization, the Indian banking system moved into something called as prime lending rate, PLR. So you know what is prime, why Amazon special customers are called as Amazon Prime customers. They are the prime, most important customers. So from a bank's perspective also, the most important customers are treated as the prime customers. Okay. Now, what is meant by prime lending rate? Generally, the rates that are there in the banks are defined in this way. When the bank sets a rate, this is how they would define. They'd say this is the lowest rate at which you can avail a loan from a bank. That's what they'll set. This is opposite of what you will find in retail stores. In retail stores, you will find this is the maximum price at which a particular commodity is sold, MRP, maximum retail price. Whereas in a bank, it is said this is the minimum rate at which you will get the loan from the bank. You will not get a loan lesser than this, rate lesser than this. Why so? And this is what is mandated. The government says you have to set an MRP, you have to follow that MRP to the stores selling products. Whereas in the banks, the RBI says you have to set a minimum rate and you have to not go below it, because in a store the risk is that people's lack of knowledge will be taken advantage of and it could be sold at a higher price. So to prevent that MRP, in a bank, competitively the banks could give loans at lesser and lesser rates to get more customers. As a result, what could happen? The bank could end up giving loans beyond its capability at lesser rates and could end up making a lot of loss. Okay, if a private company does sells its product at heavy discounts and makes a loss and shuts down, it's only that company which is going to suffer. So government is not trying to regulate that. Whereas when it comes to banking system, if the bank keeps on giving loans at cheap rates and suffers a loss and shuts down, it is not the bank alone which is suffering, it is the people's money which is at risk. So which is why they say you have to set a minimum rate which is acceptable for your bank to run without making losses. Below it, you cannot give out a loan. Below it, it's unsustainable for a bank to give out loan. That is prime lending rate. In post 1991, the banks were allowed to decide their own prime lending rate. The RBI said you decide whichever way you want to decide based on your cost factors and all those. Just that you make a declaration and make it open for everyone to see what is going to be your prime lending rate. Okay, so different banks had different prime lending rates, close to each other but different prime lending rates. Number 2. After that, there was a change which was brought in. Karthik, why would you ask whether PLR is not applicable to private banks? It is very much applicable to private banks, all banks. Prime lending rate is applicable to all banks. Okay, after this, there was a discussion with the banks and the RBI where the banks expressed that having a fixed lower interest rate is not very comfortable. It is not what liberalization is about. So make it a little more flexible. On an average, we'll maintain this as the lowest rate at which we give loans. Sometimes we may give loans to certain specific customers. We may give a loan at a slightly lesser rate. We'll compensate by giving loans at a higher rate to other entities. So they'll maintain an average that they said. So it is also called as benchmark. It was called as, after this, it was called as benchmark prime lending rate. So they introduced a revised system called as benchmark prime lending rate. This lasted till about 2005 or 2006, and then the RBI said, no, this is creating too much confusion. So let me give you 3 sets of formula. You can calculate your lending rate using any of these 3. So you have the liberal means to use one of the 3 mechanisms, but you also are following some uniform criteria. The banks were following, each bank was following their own criteria of deciding this rate. So to bring about a little bit of uniformity, the RBI said we will introduce a new system where you have an option of choosing between 3 different formula. So that was called as base rate. So base rate used to be the lowest rate at which banks could give a loan to their customers. Okay, the 3 formulae were average cost of funds based lending rate, average cost of funds based lending rate. So average cost of funds based lending rate, or they gave an option called as marginal cost of funds based lending rate, sorry, ACLR. ACLR, not ABLR. Average cost of funds based lending rate, marginal cost of funds based lending rate. And finally, one called as blended cost of funds based lending rate. Blended is a blend of average and marginal. So this is marginal cost of funds based lending rate, and B is blended cost of funds based lending rate. Blended blends average and marginal concepts. Around the period of 2014-15, RBI again said Three systems is also very confusing. Let us remove three systems and follow only one of those systems. So it was changed to marginal cost of funds based lending rate as the only system in existence. So MCLR is what is followed even now, marginal cost of funds based lending rate. But even with MCLR, the monetary policy transmission was not happening. So the RBI introduced something called as external benchmark based lending rate. I will explain these things to you. From here, I'll explain it to you. No, Karthik, private banks are not allowed to do that. Even for private banks, there is a lower limit that is set. All of these are applicable to private, public sector, all of these banks. If RBI brings in some norms, these are those norms are applicable to all banks. If government brings in some norms, it may be applicable only to public sector banks because government owns public sector banks. That is how you have to look at it. Okay. Now we'll understand what is base rate and MCLR and external benchmark lending rate. Currently, we have two systems which are running simultaneously. We have both 4 and 5 which are running simultaneously. We have MCLR as well as EBLR running simultaneously, whereas base rate is not in existence anymore. If there are still some loans which were taken using the base rate, they may continue using base rate even still. Let's say some 15-year loan was taken, let's say in 2010 or 2011, and that is still happening. That may continue in base rate, but other than that, new loans are given only in either MCLR or external benchmark lending rates. Now, what is this entire concept of? So, keyword here, first, cost of funds. Because ACLR, MCLR, BCLR, all of the C is cost of funds. Lending rate is simple. What is the rate at which the bank is lending? Okay, in this word here, lending rate is simple. What is the rate at which lending is happening? What we need to understand is what is meant by cost of funds, and specifically what is meant by average cost of funds and what is meant by marginal cost of funds. Blended is just a mix of those two. Okay. Now, what is the cost of funds? What are funds from a bank's perspective? From a bank's perspective, funds are the various deposits that they get, because that is the money using which they are giving out loans. So those are treated as funds. What is the cost of getting those funds? What is the rate that they are offering to the deposits? Okay. What is the interest rate that is offered for an FD? What is the interest rate that is offered to borrow from other banks? What is the interest rate offered to NBFCs to borrow from them? What is the interest rate offered to borrow from Reserve Bank of India? All of these are the cost of funds. Okay. So deposit rate, deposit or borrowing rate of a bank is called as cost of funds. Okay. But that is only one component of cost of funds. Okay. In addition to these, there are also other components that are included in cost of funds. The operational cost. To maintain those funds, they need to hire some people to manage those accounts, to do transactions, the banking staff, to run the bank. There is an operational cost. So there is that. Then every time deposit comes into the bank, there is a mandate to maintain cash reserve ratio, CRR, and we already discussed that CRR is a loss for the banks. We discussed that, right? Because they maintain CRR and CRR is with the RBI and there is no interest, it is actually resulting in in real terms, it is resulting in a loss. 100 rupees remains as 100 rupees after 1 year also, but its value would have gone down. So they are facing a loss. So that is called as negative carry. Negative carry means loss due to CRR. So that is something that they have to add into their expenses. And finally, something called as tenor premium. Okay, something called as tenor premium. So when a bank is giving out a loan, there are different risks associated with different durations on the loans that they give. Now imagine that you own a car. You have just recently bought a car, you own a car. One of your friends comes to you and says that I just need to go out, can I take your car? Okay. Compare this to another scenario where some friend of yours comes in and says, I need to go on a trip with my friends, can I borrow your car for, let's say, 3 days? Compare this to another scenario which says, I need your car for 1 month, I need some emergency, I need to keep shuttling between hospital and home and I need it for a month, can you give it to me? Versus someone who says, can I take your car for a year, I'll give it back after a year. Okay. One person who borrows the car for some time, one person who borrows the car for 3 days, one person who borrows the car for a month, one person who borrows the car for a year. Where is the risk higher from your perspective? The risk of getting damage to that car. The longer it stays with someone else, the higher is the risk, right? Similarly, with respect to loans also, the longer the loan is for, the higher is the risk of failure. So the lending rate also has to vary in accordance to the duration of the loans. That is called as tenor. Tenor is another word for tenure or duration. According to the duration of the loan, the interest rate has to be varied accordingly. Higher the duration, greater will be the rate of interest. Greater will be the lending rate. So these are the factors. Deposit rate, which is the cost of funds. Then you have operational cost, negative carry due to CRR, and tenor premium. Based on these, the rates are set. This is true with respect to all these, both of these structures. Both of these. In fact, MCLR we don't need to separately say, because MCLR itself is a part of that base rate system itself. We are just taking away one part and say we are removing other options, use only this option. Now we have understood what is cost of funds and what that entire system is. We just need to understand what is the difference between average and marginal. Okay, this is just for your understanding. It is not very important from an exam perspective to know this. I'll give you the example of marginal versus average in a whole different context, and then I'll explain in this context also. Let us say there are let us say there are 4 people working in a farm. 4 people working in a farm. They are producing an output of rupees 20, or they are producing an output of rupees 200. Okay. So we say 4 people are producing an output of 200. Let us say a 5th added to work plus one more person is added to work here in the farm. Okay. Assume that even after the addition of the 5th person, the output still remains the same. We have already studied this concept in a different context. Remember disguised unemployment? There is a reason why I specifically said farm. In the farm, this tends to happen. More people working, but the output remains the same. So this can happen. Now we ask a question, what is the average output here? We say for the 4 people, the average output is rupees 50 per person. Okay. We ask what is the average output here? We say it is rupees 40 per person. But we ask, not in the first case, in the second case, we ask what is the marginal output over here? Marginal output is the increase in output as a result of that one additional labor. The change in output as a result of the change in input, labor. The change in labor is 1. What is the change in output? What is the change in output? No change in output, 0. So we say marginal output of the 5th person is equal to 0. We say the 5th person is not contributing. What is the average output of the 5th person? Average output of the 5th person is 40. When you are doing average concept, you don't care about what is the additional thing. You just divide the entire value by the denominator. In marginal concept, you don't care about what has already been there. Whatever already been there, the value is given, attributed to them. What is the value of the addition? What is the contribution of the addition? Now, this is the marginal concept, average versus marginal concept. Now, let's understand this from a banking perspective. Okay, let us say a bank receives deposits, various deposits. Let's say it receives rupees 100 for a duration of 1 year. It receives rupees 200 for a duration of, let's say, 2 years. Okay, 2 deposits that it receives. So on this 1 year deposit, it is giving out, it is the cost of funds is, let's say, 5%. the cost of funds here is, let's say, 6%. It is getting money for a longer duration. So it is getting 6%. Okay. Now someone is coming and asking for a loan of rupees 150. Okay. Loan is outward direction. So let's say someone is coming and asking for a loan of rupees 150 from the bank. Now the bank has to, for a period of, let's say, 1 year, for a period of only 1 year. Now the bank has to decide how much to charge that person. The bank can easily say, okay, 150 means we have to take 100 from here, we have to take 50 rupees from here, so we have to take money from both. So 5, 6, we'll say 5.5% will be the interest. Average, you are just simply doing an average of the two interest rates and you are calculating the interest. But in a marginal scenario, you wouldn't do like that. You would say out of this 150, which is only for a duration of 1 year, 100 rupees we are taking from here. For that 100 rupees, we'll charge at 5%. Only 50 rupees we are taking from here, or on that 50 rupees alone, we'll charge 6%. So 6% on that 50 rupees is separately calculated. 5% of that 100 rupees is separately calculated. The additional amount, that is why it is marginal. The additional amount of 50 alone carries an interest of 6%. The remaining amount carries only an interest of 5%. When the interest rate calculation, the cost of funds is calculated based on the segregation, that is when it is called as marginal cost of funds. In average cost of funds, you will just simply take how much money do we have, what is the average of all the interest rates. That is average cost of funds. The more efficient mechanism is the marginal cost of funds, which is why the Reserve Bank of India said, let us not give an option of which one to follow, let us by default follow marginal cost of funds for everyone. All the banking systems have to follow MCLR. Okay. We still haven't reached the question of how does it impact the monetary policy transmission mechanism. So that is where we bring in the next concept. So here we said in the cost of funds, we talk about deposits or borrowing rates of a bank. The deposits or borrowing also includes the repo rate. Repo rate is the borrowing rate from RBI. So when RBI increases that rate, this rate automatically increases. So your rate should increase. But when this rate comes down, again similarly, the borrowing rate should come down. Okay. That was the idea behind Reserve Bank of India. When they introduced the system, they said that automatically if repo is increased or decreased, this will also increase or decrease. But what was happening was that when it increased, they increased it. When it decreased, they started adjusting it over here. In operational cost, they started adjusting in other places, or they said in other deposits, we are finding it difficult. We are not giving out, the cost is still high. So whatever, they found some reason or the other in order to not pass on the benefits of that to the people. Because it was not directly, in cost of funds, there is no direct link to repo. Repo is only a part of it, a small part of it. Okay, so it did not have the necessary impact on monetary policy transmission. It still doesn't. MCLR is still being followed. It still has that problem. So what RBI did was that in October of 2019, the Reserve Bank of India said for certain kinds of loans, for certain like MSME loans and for certain kinds of loans, the banks will have to follow something called as external benchmarking of loans. What do we mean by external benchmarking of loans? The lending rate is no more going to be decided based on internal factors. What are the internal factors? These are all the internal factors. Cost of funds, operational cost, negative carry of CRR, all these are internal factors of the bank. It is not going to be based on the internal factor. It is going to be based on some external factor. What are those external factors? I'll give you some samples. Number one, repo rate of RBI. So RBI said you can take a look at the repo rate and then you can say on top of the repo rate, I want 2% as my profit or 3% as my profit. That profit margin, the bank cannot on its own change from time to time. There has to be a level of stability. If they change that profit margin, RBI can go and question on what basis are you changing this? Okay, so an approved margin is fixed on top of the repo rate and they said, okay, now you can set the rate. Whatever is the repo rate, 3% more than you will get as your returns. You can charge as your lowest rate, which means that if RBI increases the repo rate, that rate will also increase, directly proportional. If this decreases, that will also decrease. The margin is always maintained at that level, whatever profit that they want. So this is one example of external benchmarking. They said if you don't want this, you can also depend on, there is an organization called as Indian Financial Rates Private Limited, I think. I'll just check and I'll tell you the name of that organization. I don't want you to learn the wrong name, but I don't remember the name. Okay. Yeah, Financial Benchmarks India Private Limited. Sorry. So there is an organization called as Financial Benchmarks India Private Limited. Okay, this is a sort of like a government entity which is run independently. So this organization decides or looks at the market rates. Market rates of what? Market rates of T-bills. 6-month T-bills that are there. But we already know T-bills do not have an interest rate concept, but they have a yield. Okay, based on how much people are willing to bid for those T-bills. Based on that, from that an interest rate can be arrived at. Using that interest rate, they can use that also as a benchmark. This Financial Benchmarks Private Limited will look at the T-bills, 6-month T-bills that are there. This is 182-day T-bills. So they can look at the T-bills and they can arrive at an interest rate and they'll publish it. You can use that as a reference point or any other valid benchmarks provided by this organization. It can either be repo or 6-month T-bill or any other valid benchmark provided by this organization, which are external, where the bank is not the one deciding it, it is some other organization. In this case, the RBI. In these two cases, the Financial Benchmarks India Private Limited. Any of those can be used as a reference by the bank to set their lending rate. Initially, it was compulsory for MSMEs alone, and later the banks were given an option that any loan that you give, you can use external benchmarking if you want. Even the existing MCLR loans could be shifted to external benchmarking if the customer and the banks come to an agreement about that. Even today, it is not compulsory to have external benchmarking for all loans. Only for specific business related loans, they have made it compulsory. Others, either MCLR or external benchmarking can apply. This is both 3 as well as 6. So 91 or 6-month, one of those. They can follow any of those. So maybe for a 3-month loan, they can use a 3-month T-bill. For a 6-month loan, they can use a 6-month treasury bill. Okay, so this is how the Reserve Bank of India has tried to make the system more in alignment with monetary policy. Okay. All right. So that completes our first topic here. A few other topics that are left over now. So I was discussing monetary policy transmission mechanism. It is sometimes referred to as MTM. So what is the second term now? Second term. Okay. We have something called as Phillips curve. So it's actually a very, very old concept. 1950s American economics. So this concept was there. 1950s and early 60s American economics. This concept was there. I specifically say American economics because prior to the Second World War, economics was dominated by Britishers. Britishers were there doing everything. So this is in that sense. So Phillips curve says that. Very easy curve. So here we say this is a measure of inflation and its impact on unemployment in an economy. So Phillips curve, or Phillips was of the opinion that when inflation is at high levels, unemployment tends to be low, and as inflation decreases, unemployment tends to rise. This is what Phillips curve says. It's just a theory. You need not agree with this, but this is the theory. What Phillips curve tries to say is that when there is a lot of money available in the economy, that is when money supply is high in the economy. When the money supply is high in the economy and there is inflation, there is a high chance for more and more business activities to take place. It goes by our general understanding. Higher the inflation, higher is the likelihood of production. High inflation, high GDP. High GDP means high employment, which means unemployment would be low. Okay, that is the logic here. Whatever we have discussed previously, it's the same logic. High inflation, more economic activity, less unemployment. Look at this. This is not employment, this is unemployment. Unemployment will be low when inflation is high. When inflation comes down, money supply comes down, the economic activities also go down, thereby unemployment increases. That is the theory behind. எப்படி வரும்? கீழே இருந்து மேல போற மாதிரியா? இப்படியா? அது எம்ப்ளாய்மெண்ட்னா தானே அப்படி வரும். இது அன்எம்ப்ளாய்மெண்ட். இது இப்படி போட்டா அப்படி தானே இருக்கும். What have we done right now? Inflation is high, unemployment is low. X axis. Correct தானே? Okay. Now this was, as I repeatedly told you, the old concept. Why do I keep saying old concept? Okay. Why do I say it is the old concept? This does not take into account the possibility that there might be a country which has a lot of money but it doesn't have the resources to produce. Supply side issues are not considered. This only talks about inflation from the demand side. The assumption here is if there is money, anything can be produced. That is the theory here. But it is also a possibility that there might be a country with a lot of money but no resources to produce, to use that money, be it natural resources, be it entrepreneurship skills, be it labor, skilled labor, be it government policies which are aiding, any of these. There could be structural or supply side issues which prevent a country from taking advantage of the excess money supply, which could result in hyperinflation. There is money, there is no production. There is more money, more money, more money. It could lead to a situation like that. But without going to the extreme of hyperinflation, there was a concept which was suggested during the 1970s. Why 70s? Because America itself suffered from supply side inflation, because they were using their resources to such a great extent that any further increase in money supply, they were not able to produce anything more because they had used up a lot of their resources. Their employees were becoming, the labor there was of such a high standard of living that their labor was becoming costlier and costlier. That is when America started outsourcing even their vehicles which played a huge role in America growing, the automobile industry. Japan became better at producing it, or China became better at producing, not China at that point of time, Japan became better at producing it. Vietnam was able to produce goods at a cheaper rate than America. So American companies started to push their production outside America. So they went to China, Japan, Vietnam, all these countries, they started doing it. India was not open at that point of time, so they didn't come. 1980s, service sector, they could do their own company services domestically, right? Accounting and all those. No, it was very costly. They outsourced it to India. 1980s, India's IT sector started booming because of American companies outsourcing their work. So that happened. Supply side constraints came in. So came another concept called as stagflation. It's a situation where there is inflation in the economy, but the economy is not able to grow. There is inflation, high prices, a lot of money supply is there, but the production is not increasing correspondingly. The GDP is stagnating. GDP is not increasing. Unemployment is not decreasing. With high inflation, unemployment should decrease, but high inflation and high level of unemployment. This point, it is not a line, it's a point. That point is a reference of high inflation and high unemployment. High unemployment happens when there is stagnation in the economy. High inflation, cumulatively called as stagflation. Stagnant economy plus an inflation driven economy. Stagflation. It's a single word. I just put the gap to split the word and make you understand better. This is the concept of stagflation. Okay. So this is the reason why countries have a target for inflation. Countries, see, otherwise you could have uncontrolled inflation. More the inflation, more the GDP means that you could have unlimited levels of inflation and the GDP will also grow at unprecedented levels. This makes it necessary for every country. The concept of stagflation made it necessary for every country. So that is number 3, okay. This is concept number 3. Number 2 is Phillips curve, number 3 is stagflation. Concept number 4, which made it necessary for every country to have some sort of an inflation target. India also has an inflation targeting mechanism through a committee called as Monetary Policy Committee. See, previously, prior to this person called as Raghuram Rajan taking over Reserve Bank of India as the governor of Reserve Bank of India, entire power of monetary policy lay in the hands of one person. Reserve Bank of India governor had the sole authority in deciding what should be the monetary policy. That particular Reserve Bank of India governor, Raghuram Rajan, felt that this is too much power in one hands. Obviously, no employee of Reserve Bank of India is going to go against the governor and say what you're saying is wrong or I have a different opinion. Okay, see, when you're setting up an authority, there has to be a proper checks and balances. There is no check and balance here. One person having far too much power. At least in the government, when government is trying to control money supply or whatever it is, there is always a check and balance. Parliament is there, opposition is there. In RBI, there is no such case. That is why the governor himself said it is too much power in my hand. It is not safe. We'll have to find some other entities also. There have to be checks and balances. So, Monetary Policy Committee was set up, which consisted of 6 members, 3 from the RBI, 3 from the Government of India. But remember, ultimately, Monetary Policy Committee is a RBI body. Monetary policy is RBI's function. So, Monetary Policy Committee has to be an RBI dominated body. When the number of members are split as 3 and 3, how to give RBI its domination? By making RBI governor as the chairman of this body. That is when it can become an RBI body. When RBI governor, so RBI governor is one of the 3 members here. So RBI governor is one of the 3 members. You also have one RBI deputy governor. There are 4 deputy governors in RBI. One of them is assigned for this purpose. Not in rotation. One person, one of the deputy governors is always assigned the role of one being a member of the Monetary Policy Committee and one other official from Reserve Bank of India. Now, what is the difference between the deputy governor and official? Governors and deputy governors are appointed by the government. Officials are actual employees of RBI throughout. They would have got promotion and reached that stage. They may themselves grow to become deputy governor or governor, but they have been employees of RBI for a long time. Governors and deputy governors are appointed by the government from within RBI or from outside RBI. That is the difference. Those are the 3 members. And when RBI governor is heading this committee, it's not practical to have a minister over there. There will be a conflict. So these 3 are not ministers. They are not government servants or anything. These are 3 members nominated by the Government of India who are experts in the field of finance and economics and administration and all those. 3 members nominated by the Government of India. So they will do a discussion and debate and all those, and then ultimately decisions are taken. When the decisions are taken, if there is a situation of conflict, it can only lead to a 3-3 scenario. Okay, 3-3 scenario. When voting takes place, 3 votes to RBI. Obviously, others are not going to resist governor's point of view. 3 votes to the government. If there is a case, ultimately we have to remember it is an RBI body. So the tiebreaker, the casting vote lies with the RBI governor. In case of a tie, RBI governor gets a second vote to be the tiebreaker, which clearly shows that although opposing views are heard, Monetary Policy Committee is still an RBI body. Okay. That's number 4. Number 5, something called as GDP deflator. Now think of GDP deflator. Today is when we learnt about CPI, WPI, right? In the morning, first class is when we'll think of GDP deflator as exactly like a price index. It's a price index of the current year. GDP deflator is a price index of the current year. Okay. But this price index, for this we need a basket of goods and services, right? This basket of goods and services is a reflection of the, not just the consumer side. In CPI, we looked at from the consumer side. In WPI, we looked at from the producer side, but only those production which they were including in that particular basket. Here in GDP deflator, what are we trying to do? We are trying to deflate any existing inflation in the GDP calculation. Why is this necessary? GDP, the formula is Q into P. This P could be the current price. This is most likely to be the current price, which means that current price is including inflation. Now, last year, let's say 2019, 10 products were produced at 10 rupees, GDP was 100. This year, 10 products were produced at 12 rupees, GDP is 120. If you simply look at GDP, you don't know whether there is an increase in production or is it just driven by inflation. So, to understand that, you need to deflate the inflation over here. This GDP, these are nominal GDP. You know what is the concept of nominal, we discussed in the last class, without adjusting for inflation. This 120 is nominal GDP. So there comes the concept of GDP deflator. Real GDP is equal to nominal GDP divided by GDP deflator into 100. Now, what is this 100 actually? This 100 is nothing but the price index of the base year. This 100 is nothing. Price index of the base year is always 100. You know that, right? So, this formula is to be written this way. Okay. Nominal GDP divided by real GDP is equal to GDP deflator, which is nothing but the price index of the current year, divided by 100, which is nothing but the price index of the base year. Nominal GDP, GDP deflator, the current price levels, price index. Real GDP, which is GDP in terms of the base year prices. This is how you have to do it. But what we are trying to find out is real GDP. So we'll say real GDP is equal to nominal GDP by GDP deflator into 100. This is the formula. Okay. GDP deflator is nothing but a price index which is reflective. Let's say 100 is the base year price. 110, 120, 130, whatever is the case. In the earlier case, GDP deflator would say, if we take into account all the goods and services which are produced in India. Why? GDP is nothing but the total value of all final goods and services produced in India. Okay, so it will try to take into account as much of the goods and services that are produced in India and reflectively show a price level, create a basket of goods. It doesn't matter whether these are production goods or consumption goods and all this, it will include everything. WPI only includes production oriented goods. CPI includes only consumption oriented goods, not production oriented goods. Crude oil and all those will not be included in CPI. Similarly, your final consumption products will not be included in WPI. In fact, CPI will also include imported goods. CPI will include imported goods also. Why? Because those are consumed in India. Your GDP deflator will include production-oriented goods, consumption-oriented goods, all those goods, but it will not include imported goods because they are not part of the GDP. So it will be a wider basket of goods and services than CPI or WPI, and it will reflect the price levels in the economy, but not separated as consumption and production side, which is why it cannot be used as a reliable indicator of inflation across the economy, but it is used as one indicator to deflate the GDP. Okay, so this deflator is used to deflate the level of inflation. Let's say the nominal GDP is 120 in the previous example, which means that the price level will also be 120. It's a very simplistic example. Okay, so price level will also be 120. 120 by 120, 1 into 100. Now let's just take this example slightly differently. Let's say this is 100 commodities being produced, 100 commodities being produced at 12 rupees. So it will be 1000, this will be 1200. Now take the same, it will be GDP will be 1200 divided by price level will be 120. 100 becomes 120, 20% rise in price. Why do I say so? 10 rupees is becoming 12 rupees. That 2 rupee increase is nothing but 20% increase. 12 minus 10 divided by 100 into 100, 20%. 20% is reflected as 120, 20% rise. So 1200 divided by 120 into 100 will give us a value of 10 into 100, 1000. So real GDP would be 1000, which is what is true over here. GDP calculated at base year prices is equal to 1000. Okay, so I hope you have understood the concept of GDP deflator. Two more things I have to say here. What is nominal GDP? Nominal GDP is GDP calculated at current year prices. Note down. Nominal GDP is GDP calculated at current year prices. Real GDP is GDP calculated at base year prices or constant prices. In the base year, the price doesn't change, so it is also called constant prices. Real GDP is GDP calculated at base year prices or constant prices. In some textbooks, you will find this formula being written as GDP deflator is equal to nominal GDP divided by real GDP into 100. Okay, this goes here, this comes here. To me, it doesn't make any sense because the objective here is not to find the GDP deflator. The objective is always to find what is the real GDP. Okay, so you have to write the formula in this way, but if you ever come across a formula like this, if you get a UPSC question says what is the formula for GDP deflator, you should know this also. Conceptually, it doesn't make sense. If you already know the real GDP, then why do you need the GDP deflator alone? You have other ways of calculating inflation, right? So what you need is real GDP. GDP deflator is a way of deflating the inflation driven or inflation filled GDP. That is how you have to look at it. Okay. Do you know what is meant by inflation? Just winding up. Do you know what is meant by inflation? Define. Persistent rise in general price levels. You can also define inflation. Within inflation, you can break and create something called as inflation and disinflation. Both are types of inflation, but there is a classification here. Inflation is an increasing rate of inflation. Increasing rate of inflation is inflation. A decreasing rate of inflation is disinflation. Do you understand what is meant by decreasing rate of inflation? Rate come here, exactly. Now take a look at this. 100 rupees is the price of something. It increases to 105. It increases to 115. It increases to 130. Price difference is 5. Price difference is 10. Price difference is 15. Now, here the price rises to 140, but the price rises only by 10. Here the price rises to 145, the price rises only 5. Price remains at 145, no inflation. So, all this is inflation. From here to here, it is inflation because at every step of the way, price is rising. But till here is what we classify as inflation. Beyond this, what we see is disinflation. There is inflation happening, but it is showing a decreasing trend. The rate of rise in price is decreasing. Okay, there is a distinction like this. Now, similarly, we have a concept called as deflation and reflation. By general definition, deflation is decrease in prices of commodities, opposite of inflation. But specifically here, consider a scenario like this. 145 is the price. 145 decreases to 140, decrease of minus 5. Decrease of 5. Reduces to 130, decrease of 10. 115, decrease of 15. So it is decreasing at an increasing rate. Decrease of price at an increasing rate is what we call deflation. Okay. 115 reduces to 105, decrease of 10. 105 reduces to 100, decrease of 5, remains at 100, no decrease. This is deflation. This is what we call as reflation. It is moving towards inflation. The prices are still decreasing, but at a decreasing rate. It looks like eventually it will go and start rising again. So that is reflation. This is inflation. This is disinflation. This is deflation. This is reflation. You are not likely to get confused between this and this. You are likely to get confused between disinflation and deflation because of the word dis over there. You might think something is reducing. Disinflation is still inflation. It is a decrease in the rate of inflation. Deflation is a decrease in the prices. Okay. So with this we have completed inflation. Okay. We still have some bit of making up to do. Last class we lost about 15 minutes in the beginning, and then 5 minutes or 10 minutes due to technical issues, right? It's okay. We'll not do it today. We have one more class this week. You know the schedule, right? Wednesday, if I'm not wrong. Wednesday, 6 to 8:30, right? I think it's Wednesday. Core economics, yes, Wednesday, right? 6 to 8:30. Do you guys want to come here and do the class, or will it be online? I don't know how it's been scheduled. Weekday classes, online only. You will not be coming here, right? Weekend classes mattum dhaan inga. Okay. Because if you guys are not coming here, I don't have to travel here. It's closer for me to take the class from Adyar, from where I live. That's why I'm asking. சொல்லியிருக்கிறதே வெறும் வீக்கெண்ட் கிளாஸஸ் மட்டும்தான் இங்க இருந்தானா? Okay, fine. Okay, then I'll be taking class from there. So I just wanted to be clear. I don't want anyone to come here and expect an offline class on Wednesday. So that's why I was asking. Okay, if you guys don't have any other questions, you guys can leave. I'll take up the online questions if there are any. You guys can leave. You don't have to wait for me to finish talking before you leave. If you have questions, you can stay back and ask. Looking at online questions. Okay, explain repo roll once again. You can't get it in external benchmark. Nothing, Saravanan. The concept is very simple. Banks are supposed to set their lending rate by looking at repo rate. If the repo rate is 5%, and if the banks want, after all their operational expenses and all those, if they believe that with 3% or 4% they are able to make up all the expenditures and get their profit also, then their lending rate will be repo rate plus 4%. Whatever the repo rate plus 4%. So if the repo rate increases, this will also increase. If the repo rate decreases, this will also decrease. That is called as external benchmarking. Chandramohan says, sir, will real GDP reflect the current condition of nation's economy? It is not about the current condition. Real GDP will reflect whether there is an increase in production activity or not. So GDP, nominal GDP increases. You don't know whether the GDP is increasing as a result of production increase or as a result of price increase. If you look at real GDP, it is GDP calculated at constant prices, right? When the price is kept as constant, you would know with certainty that if real GDP increases, the production activities in the country is increasing. So you are removing the impact of inflation. There are two things, Q and P. You are removing the impact of a change in price. You can get to learn just the impact on production activities. Okay. So thank you for that answer. All right. Thank you. Could you please explain again why MCLR is better than ACLR? Helen, it is the question. It's better because in MCLR, you are looking at the actual cost that the bank is having to pay. The bank is giving out a loan of 150 in the example, of which on 100 rupees alone, its cost is 5%. On the remaining 50 rupees alone, its cost is 6%. Why should it be generalized and taken the whole cost as 5.5? If 100 rupees is 6% and 100 rupees is 5%, automatically ACLR and MCLR will be the same. But out of the 150, only 50 rupees is at a cost of 6%. The remaining is 100 is at a cost of 5%. So if you do the marginal cost, maybe the lending will be at 5.3% or something like that, not 5.5%. So it is a better reflection of the cost of the bank itself, the marginal concept. That is why marginal is a better concept. Can I explain disinflation once again? Yes, Soundarya. Disinflation is a situation where the prices are rising. Say, let's say last year there was an inflation of 10%. This year there is an inflation of 6%. The price is still rising, but by a lesser margin. To give you a broader perspective, welcome. To give you a broader perspective, think of this. Country's GDP is growing by 6%. Next year it is growing by 7%. Next year it is growing by 8%. It is like equivalent to this inflation. The year after that, it is growing, but by only 5%. We say slowdown in growth. We are not saying recession. We are saying slowdown in growth. Slowdown in growth is similar to disinflation. Whereas when GDP becomes negative, GDP growth rate becomes negative, that is what will be equivalent to deflation. There is a positive growth, but the rate of growth is decreasing. Okay, clear? You can give me a thumbs up. All right, sure. Can I show the last slide of deflation and reflation? Yes. Could you please repeat Financial Benchmarks Private Limited as well? Okay. Meenakshi, so Financial Benchmarks Private Limited is an organization whose only role is to look at the market and say what are the interest rates in the economy. That is their only role. So their interest rates are very reliable in nature. So that is why that organization is tasked with coming up with the interest rates for T-bills or any other interest rates, and whatever rate they come up with, that is a reliable interest rate. Nishchit wants to be unmuted. Just a minute, Nishchit. I am unmuting. I'll unmute you right now. Yes, Nishchit.
Hi, sir. Thank you.
Hi. Yep.
So I want to ask about invoice discounting. So invoice discounting is something. So consider there are two companies, say A and B. So where B is a MSME and A is a bigger company. So B is supplying some some materials to A, and is expecting a payment in 90 days.
Okay.
So for which company A gives an invoice to B, so which can be redeemed only after 90 days. So but the MSME needs the money right now.
Okay.
So what it does is it will go to a bank, or in case it will go to some other place, platforms, but we consider let it go to bank.
Okay.
So where bank will offer offer a price, offer the amount in a discounted discounted way. For example, if the amount is 100 crores, so bank will give 95 crores.
Okay.
So because MSME needs it at that time itself. So that invoice will be given to bank. So the bank will take 100 crores from company A. So after 90 days.
That's exactly the concept that I was teaching. That's exactly the same.
Yeah. So this amount. This voucher will the bank can go to RBI and pledge it and get the money, or is it possible?
It can. It is a form of bill of exchange. That invoice is a form of bill of exchange. It can be done.
Okay.
All right.
Thank you. This is what I wanted to ask you.
All right, man. Sure. All right, guys. Sir, any general question you will be giving? Yeah, I will be Radhakrishnan. Will be the last time that I give. Okay, I think I've answered all the questions that were raised. If no further questions, then I'll disconnect. We'll see in the in Wednesday's class. Thank you so much. Are you guys waiting for me? Lala?